There is some reason for optimism. If you look at inflation around the world, it's on a downward glide path.
If you emphasize the word landing more than soft, I think we've achieved it.
We're going to see volatility, but the trajectories are in place for lower rates, for less inflation, but not on an even keel, if you will.
I believe that the Fed is going to take its time, especially without a recession.
They're going to start lowering at some point. When they're ready, they're going to be prudent, they're going to be thoughtful.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From Davos to New York City for our audience worldwide. A very good morning. It is Bloomberg Surveillance alongside Scarlet Fu. I'm Manus, Cranny. They brought you back from the end of the day and they've resurrected me. Good morning, Scarlet. How are you?
Good morning. This is so great. We haven't done this before at this hour, at least.
14 years at Bloomberg, and this is the first time that we're in the same zone. And it's been a shortened trading week. They've been in Davos. The rhetoric there has been all about when will the Fed cut, will they extend and pretend? You just look at the rates market. This rates market has backed up the truck, up 20 basis points on 2s and 10s through the week.
Everybody has an opinion on when the Fed will cut rates. Nobody knows anything, including the Fed, because they're data dependent, right? And the data this week indicated the U.S. economy is holding up just fine, whether you're looking at retail sales for December or jobless claims, which really shows a bedrock of U.S. labor strength. So there's repricing going on, and there's going to be a lot more repricing in the days to come before the Fed meets on January 30th and 31st.
Yeah, they're getting incrementally better pieces of data. And, you know, good news is bad news. That awfully trashy line that we have, good news is bad news. Well, 20 basis.
But it's not, because the NASDAQ is at a record high.
Exactly. And the Mag 7, if you look at the components who actually benefited the most yesterday, it was part of those magnificent 7. And if you look at the flow show from Bank of America, I just grabbed some of the numbers from Hartnett's note before it came on air. So the Mag 7, you've got technology stock funds, and this is the interesting point. As these yields back up, you've got technology funds taking in $4 billion over the space of 2 weeks. So as for breadth, hello, I can't see it.
Right. The Russell 2000, which was supposed to really extend on its gains made at the end of December, what happened to it? It's kind of faded. We're going to talk about all of that because the January effect seems to have not taken effect at all.
No, not at all. I think it's interesting when you listen to the voices that have come from Davos. We caught up with a multitude of them, with Francine, with the surveillance team.
Sure.
Schwartzman saying, you know, the timing of the rate declines won't be clear. It's going to be baffling for investors. And I think that's what we have at the moment, which is disinflation. It's behaving itself. But there is this view. Waller did it. Bostic did it. They are pushing back the timeline on these rate cuts, and this market has yet to really adjust to that.
Right. Certainly not 6 rate cuts, which is what the market had been pricing in, and the Fed itself sees something more like 3. The other question is, what will the election do, or how will that affect how the Federal Reserve moves? Because if it doesn't start cutting rates until the second half, the closer it gets to the election, the more likely people will accuse it of being political if it does start to really cut rates into the end of the year.
I think my favorite scene so far was the obsession in Davos about whether Trump would run on the ticket and whether he would win, and there would be another 4 years of Trump in the White House. And it was that moment when Christine Lagarde, when she was asked what she thought, she sort of paused for very dramatic effect, because we're good at that, Scarlet and I. And she goes, I'll have some coffee.
Yeah.
And then she proceeded to answer, they're nervous as hell.
She gave a very diplomatic answer. Of course, she said it's up to the American people to decide, but you can be sure that there's a lot of scrambling in the background of people trying to, you know, look for their old playbook in terms of how do you deal with another Trump administration. And
of course, 2 hot wars, the funding for those wars. We're going to talk about those issues through the next 3 hours. We've got 3 hours together. Are you excited?
I'm thrilled.
We're going to turn up the temperature in here because we're both freezing. Let's talk about markets. We've talked about the backing up of the truck in the yields. Let's just give you a quick snapshot. There we go. S&P 500 up 0.4%. Equities continue to trade higher, even though investors dump over $4 billion worth of U.S. stocks in the past couple of weeks, according to the Bank of America Flow Show. Euro dollar, I know you wanted to talk about that, 108.81. We've got 10-year yields trading at 4.13, up 20 basis points, 21 basis points on the week. And the oil market is still, my favorite word, phlegmatic.
What does phlegmatic mean?
It just means not paying attention. It's really, really sort of flaccid in terms of its reaction function to the issues in the Red Sea, and for as long as it doesn't take place in the Strait of Hormuz, that oil market is going to focus on supply.
Yeah, but in the meantime, it is something that everyone gets very nervous about. We see WTI approaching 75, Brent approaching 80, and kind of stuck around those levels. We know that there is plenty of supply for now, and OPEC Plus is scrambling in terms of trying to figure out how they calibrate everything.
Yeah, and the Russians are exporting like Billy. But let's take this confluence of issues to Dan Morris, Chief Market Strategist at BNP Paribas Asset Management. Dan, good to see you. Waller backed up the rates truck. Bostic helped him. We've just romped home 20 basis points on 2s and 10s this week. Has that jolted your thinking in any material way? Good morning.
Good morning. Well, I think what's notable is the market actually seems to be listening to what the speakers are saying. We certainly had times in the past when the Fed's tried to talk against what they see as an inappropriate market narrative. Sometimes the market listens, sometimes they don't. It's encouraging. We think that the market is listening to what the Fed is saying, and importantly, not just because the Fed FOMC members are saying it, but because we think it's supported ultimately by what the backdrop is in terms of inflation and growth, which is that inflation is not going to decelerate as easily or as quickly as the markets expect, and that's why the Fed isn't going to cut as much as the market had been forecasting.
When we talk about the market, is the bond market hearing something different from all this Fed speak than the stock market? Because as Manus and I were just talking about, yes, bond yields have moved higher, but so too have growthy stocks like the NASDAQ 100 making a record high.
Sure, we've got to keep in mind that at least on the equity front, it's not only about rates, whereas clearly with fixed income, it is what's happening with rates. And I think we've got to calibrate what the impact is with higher real yields, which you're absolutely right, should have a negative impact on growth stock via valuations. But we're also in the midst of the earnings season. So at times, and we actually saw this in a major way last year, earnings optimism can outweigh temporarily, at least, what the impact is on higher discount rates. So we had the big AI boom pushing through earnings for tech stocks last year. Maybe we're seeing a little bit of that enthusiasm at the start of this year.
Yeah, the enthusiasm coming from TSMC, giving the whole chip sector some renewed hopes that they're turning a new page and they're at the start of a new cycle. How long does this enthusiasm last for? I mean, is it a temporary boost or is it something that'll last?
And well, broadly, I think for tech earnings, if you look at consensus estimates for this year, tech earnings are supposed to be up in double digits. Now, maybe it's not going to be quite as high as that for the year, but I think double-digit earnings growth out of, say, a broad NASDAQ 100 index is I think, what investors essentially are counting on. And so far, tech stocks have been able to deliver. So as long as we're in that range, it's better than about any other index can provide, and that's certainly why the enthusiasm is there, the flows are there, and also the valuations.
The question I had for Binky Chadha yesterday at Deutsche Bank, his target's 5,100 by the end of this year. And I asked him, is that predicated on earnings expansion, or can you deliver that without 5-6 rate cuts? And he said, I can deliver, my estimate is 5,100 without any rate cuts at all. Do you think you can get that kind of momentum in equities with no rate cuts? Because that's quite a bullish landscape that you paint. It's predicated on earnings.
Perhaps it's a hypothetical. I don't know how much it's worth exploring, given that we're almost certainly going to have rate cuts this year. So, I mean, that's got to be part of the calculation you have for returns for equities. You're right, it does make a difference if it's, say, 3 cuts or 6. But ultimately, if it's lower rates at the end of the year than we have today, higher earnings at the end of the year when we have today, I mean, that seems to be a pretty supportive environment for equities.
When you look at the backing up of yields that we've had, you begin to ask the question, will there be a re-entry point that you will see bond buyers come in on the 10-year government bond? When you see 20 basis points in the space of a week, does that enrich the bond market, do you think?
Well, certainly if we get much higher than where we are today, I think you're more likely to see some portfolio managers going overweight on the outlook for nominal yields. I mean, right now, I think we're probably still in a position where the market needs to still recalibrate its expectations for the Fed. Mm-hmm. So I think the risk probably in the near term is more higher rates than lower rates. But certainly if you get high enough, see what the next information we get on inflation. If it's a bit higher, which we think is actually a risk, we could get a bit more inflation premium baked in, and that could be the opportunity you're talking about.
You know, Daniel, investors like Bill Gross are betting on a steepening of the yield curve, a normalization of the yield curve where you get rewarded, of course, for taking on more risk of lending money over a longer term period. What is going to be the catalyst for that shift? Because we've been waiting for a while.
Well, it's certainly been the timing of the Fed cuts that's really going to be driving the steepening of the curve. So again, it goes back to, is it at all realistic to think the Fed, or was it even realistic before to have thought the Fed would cut in March? We never really thought that made a whole lot of sense. So we are going to have to wait a bit yet, but we do think that's going to come.
You would also point out that the rally in real rates since the beginning of the year looks a little bit under pressure. So, how much attention do you think the Fed are paying to the real rate scenario? I mean, it's core to what they're about, isn't it?
Well, absolutely. I think ultimately, though, I think really where the discussion needs to take place is kind of where do we need to be in real rates, say, 5 years from now? If you look at the long-run projections from the Fed for the Fed funds rate versus what the market has in for the long-run Fed funds rate, you still have about 150 basis point gap. So there's a real discussion to be had about what is the neutral rate of interest for the U.S. economy, how strong can it grow at a particular rate of interest, inflation, all these things. So we don't want to forget when we focus very much on what the Fed's going to do next, really is going to be these long-run discussions that are going to drive both markets, equities, and fixed income.
We've just spent a week with lots of guests in Davos talking about the risks from the Red Sea, the risks of U.S. politics, the risks of 2.5 hot wars, the half being in Taiwan and the U.S., Taiwan and China. What is the most material risk to delivering underwhelming equity results this year?
I guess if we look back to the Russia-Ukraine conflict as an example of where something that's clearly a very significant geopolitical event can turn into a very significant macroeconomic or market event. And what was not necessarily unique but unusual about this situation was the direct impact on energy prices because of Russia's dependence on Russian natural gas. So if you think about the geopolitics, it's then where do you also see a very immediate link to some kind of macroeconomic factor. So I think that's going to be it. So, we initially, of course, always go to the Middle East and the risk of significantly higher oil prices that would have a negative global impact, and that probably is still the outstanding concern that we have.
Yeah, and as yet, we still haven't seen any material war risk premium come into those oil prices. Dan, thank you very much. Dan Morris, BNP Paribas Asset Management, our first guest of the day. There you go. So it's interesting. Nobody got any of the outlier risks right last year. They didn't get any of the bank crisis in March. They didn't get the Israel-Hamas, of course, shock attack and terrorist attack and ensuing war. These are all black swan events, and by their very nature, you just don't know what they are until they're in your face.
The other black swan event was the U.S. economy doing very well and holding up and not going into recession. Because at the start of the year, everyone was predicting recession.
Exactly. My favorite line goes to Paul Donovan, I think, for 2023 from UBS. Never underestimate the hedonism, or never go short the hedonism of the U.S. consumer.
We like to spend.
A lot to spend. Let's have a quick snapshot of what's going on in markets. It's just gone, where's the clock? Different studio, 6:13 a.m. This is what we've got. Stocks are rising. Bond yields are also on the march this week as well. We've gone back to flat 413, but we've put on 20 basis points this week, haven't we?
Yeah, it's been a big move for this week. We're not seeing a whole lot right now. Of course, the big data points already came out this week, so we'll see how it all shakes out ahead of next week.
Indeed. Okay, we'll keep you abreast of things. 7 a.m., we're going to catch up with Margaret Patel of Allspring Global Investments, see whether she believes in the hedonism of the U.S. consumer and the backup in yields. This is Bloomberg.
The Trump election, the first time around, we all looked around and thought about putting in hedges.
The whole problem is it's completely unpredictable. But, there's no appetite for that.
When we look at the likely policies, there may be some serious concerns.
When he was president, spending about 75% of the NATO budget, and the rest of NATO was only doing 25%. This was exactly Trump's main issue, that we were not spending enough, and he was right.
There's very little sign of fiscal discipline from either party right now, which is, I think, concerning.
We are all concerned about it because the United States is the largest economy.
I think there's just too much to be decided. If you look back the first time, there was a lot of concern, apprehension that didn't necessarily materialize.
Everything changes if Trump wins, and mostly for bad ways.
That's the opinion coming from some of the top business leaders in Davos on the possibility of a second Trump presidency. We'll dig into that in just a moment with our guest, Wendy Schiller. Snapshot of risk for you this morning. Equities are higher, bond yields are flat, but they put on 20 basis points in the week. 413 is where we trade, and the euro dollar struggling for direction. We're going to get the University of Michigan inflation expectations a little bit later on, and crude is up barely 0.1%. Let's reflect on that series of signs with Wendy Schiller, Policy Director at the Taubman Center for American Politics at Brown University. Good morning, Wendy. They are nervous. The global elite are quite literally shaking in their boots that there's a second salvo coming towards multilateralism. Is that well-founded?
Well, I mean, I think you can argue that pulling out of international agreements, ending the Iran-U.S. nuclear agreement or multinational nuclear agreement, pulling out of the Paris Accords, that signals that the United States will retreat. Certainly the statements that former President Trump made and continues to make about Russia-Ukraine suggests not as strong a commitment to Ukraine as under the Biden administration. However, at the moment, the Biden administration and Congress can't get a Ukraine aid pass, a bill passed right now. And there are some questions about the efficiency of that aid and whether there's any corruption in that aid and how long will this continue. So in some ways you see, okay, I can predict from the past what the Trump administration would do in the future, but like everything else, the world has changed. And so it's really unclear where Trump will stand on this, but you can imagine he will be less engaged and less willing to make the United States engaged in international conflict.
If you look at, and we'll touch on this in just a moment, obviously the U.S. playing its role in the Red Sea, launching missiles against the Houthi rebels in Yemen. So Biden's administration is walking the walk in regards to defense. But one would have to question whether these past 4 years has left the U.S. still as that real backstop to the world in terms of security. Is the Biden administration really fundamentally different to its global position as Trump was?
Well, I mean, Trump would probably say the same thing as Biden says, which is this is really about commerce. This is about attacking, civilian commerce ships, that the international community's commerce has to continue and that you can't threaten the commerce. And I think Trump would be on the same page there. The Biden administration has softened a little bit on tariffs with China, but not as much as people expected. And our relationship with China is probably, you could argue, no better, really substantially, than it was under Trump, even though the Biden administration has made efforts. So when you think about outcome, you think on foreign policy and international engagement, we don't see as much difference between Biden and Trump as people thought. The border is a little bit different. The rhetoric from the Trump administration and the actions from the Trump administration were significantly different. And that's exactly what Trump and the Republicans are running on now, saying when we did it, the problem was less acute. You can debate those numbers. And now with Biden, the United States is less safe from the southern border. That seems to be resonating if you look at the primary poll results, at least in Iowa and now upcoming in New Hampshire.
One thing that future Trump administration would have to deal with, of course, is what's going on in the Red Sea. The tit-for-tat attacks there between the Houthis and the U.S. and the U.K. We did hear from President Biden just yesterday on how they're stopping the Houthis and whether it's been effective. Take a listen to what he said.
Well, when you say working, are they stopping the Houthis? No. Are they going to continue? Yes.
So when you say, are they working to stop the Houthis? No. Are they going to continue? Yes. That's not a very helpful answer. It doesn't really give us much of a roadmap for what's to come. Can you give us a sense of whether there is a correct way of addressing this, or is the Biden administration creating a situation that basically has the potential to blow up into a bigger crisis?
Well, I mean, I think the Middle East is really, hot right now, you can argue. Certainly when Saudi Arabia and the Houthis and Yemen were having conflicts and there were a lot of civilian casualties, the United States was saying, don't kill a lot of civilians. We don't see to have the same rhetoric necessarily with Israel, although now the Biden administration is saying don't kill a lot of civilians after many civilians have died in Gaza, in addition to the civilians killed in Israel. So now the United States is in a position of, unless we're going back full scale, which there's no appetite for amongst the American public, you can argue, on either political side, that, what can we do? We have destroyers, we have ships, we can do drone attacks, which is what we do. But, I think the the forces in the Middle East that want to be disruptive do not believe the United States will come back full scale. And I think that's where the looming Trump administration, that makes it even more certain in their mind that the United States will not come back full scale.
Of course, it's not just the executive branch's responsibility. You need to get the legislative branch involved as well. But Congress has their hands full for most of this month and the rest of next month in trying to come to some kind of agreement after they did avert a shutdown. They need to come up with new agreements post March 1st and March 8th. Can Congress get anything done beyond passing yet another continuing resolution?
That is an excellent question. I think we're all looking at that because I think the issue is that there is an agreement in place. There was an agreement struck with the debt ceiling, actually agreement to raise the debt ceiling. And that agreement has, sort of called top line spending, right? How much can we spend? How much do we agree? There are people within the Republican Party, very conservative, who want to renegotiate that, who want to cut spending even further than that agreement. And the Democrats and President Biden are holding firm. A deal is a deal. We're sticking to those numbers for the rest of fiscal year 24. That will be the fight. And Johnson has to really make sure, Speaker Johnson has to make sure that he can negotiate an agreement that can get through the House. He's done it now with the short term. Can he do it with the longer term? This will be absolutely something to do with Trump. Trump doesn't want the GOP to look like it can't run the country. If he's the nominee, he wants to run with a strong GOP at his back. And if they do shut the government down, that suggests that they can't function. That hurts Trump. And you can imagine Trump will be on the phone to Johnson every single day saying, don't make me look bad.
Will Johnson last the course? I mean, he rebuffed last-minute sort of attempts by the ultra-conservatives, the Freedom Caucus. He's not fulfilled the promise that he made to them in November, which is no more temporary extension. Will he last? Will he last the mile? Is Trump fully behind Johnson? Is that what we look towards?
I mean, Donald Trump is only fully behind Donald Trump at any given moment, on any given day. So no politician can ever expect that he will stay loyal. You have to basically, feed him, right? And so every day they'll be talking. And if he's doing something that makes Trump look good and is supportive, Trump will stay with him. The Republicans really have to start to think in the Congress going into summer and fall where they're vulnerable, where they might lose seats and lose the majority, and how popular Trump is. That's the complicating factor for the party itself and for Johnson. Johnson wants things to go smoothly. And as you get closer and closer to November, you can imagine most of the GOP wants things to go smoothly as well, because they like being in the majority more than they like being in the minority.
Very, very quickly, in 30 seconds, we're going to New Hampshire. Haley, DeSantis, just very briefly, what do you think the call will be there? Strong innings?
At the moment, it looks like Trump has momentum. If Haley can show closeness, Haley stays alive till South Carolina.
Okay. Live to fight another day. Wendy Schiller, thank you very much. Brown University with her very latest on thoughts. I mean, that's an imagery, isn't it? Feeding the leader of the GOP.
It's all about momentum, the big momentum for any of these political nominees, right? And right now, Trump has it. DeSantis has lost it. Haley's trying to recapture it.
There you go. Coming up, we're going to talk to Lindsay Piegza of Stifel right here on Bloomberg. A very good morning. This is Bloomberg Surveillance alongside Scarlet. I'm Manus, Cranny. Let's give you a snapshot of where we are 30 minutes into the show. We've got a pretty much risk-on flow show for you. Equities are higher, up 0.4%, even though investors dumped over $4 billion of U.S. equities in the past couple of weeks, according to Bank of America. NASDAQ took out a record high yesterday. The Mag 7 remain resplendent, and the hedge funds are fully bailed in there. Russell 2000, so much for breadth. It lags the two peers of the S&P and the NASDAQ, but still up 0.25%. Roll it over, have a look at bonds. You put on 20 basis points, both at the short end and the long end. We give a little bit back this morning in terms of the 10 years, 4.13. There's a narrative building in the market, Scarlet, isn't there, about re-steepening of the curve. It's one of the themes on the Bloomberg terminal this morning.
But the Fed would have to cut rates, and nobody knows when that's going to happen. And there's a big debate. Did you know that? About when that's going to happen?
There's a big debate. Well, Bostic, reaffirmed Waller's debate, didn't he? A quick snapshot of FX. You've got a nice interest in euro dollar. I mean, the dollar put on 1% this week.
Yes.
So that's, that's interesting. That's on the backup on yields.
Right. And the dollar, of course, its strength has huge implications for other central banks. I'm thinking in particular of Japan and the fact that it's getting dollar dollar yen is getting close to that point where maybe Japan would need to intervene. We've heard Taiwan and China also try to bring some calm to their currency markets.
Yeah, I mean, if you look at Bank of Japan, excluding, I always wondered about this, I know why it is, excluding fresh food. I understand why. Inflation there is 3.2%. And the finance minister, Suzuki, again, he's closely watching. That's the trigger word for potential.
Closely watching. I love economics where we talk about closely watching being the trigger words.
Listen, well, I tell you what, when they ring you and they say, do you want to go to Japan and cover the Bank of Japan, you know, for a nice long trip, you won't be saying it in that tone. You go, yes, I'm off to Tokyo, because the whole world seems to be either bail in and buy Japan, put your money anywhere else apart from China and Asia, and it seems to be the destination is Japan.
Thank you, Warren Buffett.
Thank you very much. Let's buy the brokerages companies. Let's talk about under surveillance this morning. This is what we've got for you. We've talked about it all week. Spirit Airlines, they're downplaying speculation that it's planning a bankruptcy-driven restructuring, saying in a statement, quote, Spirit is not pursuing nor involved in a statutory restructuring. However, Reuters reporting that Spirit is pushing JetBlue to appeal the decision, blocking the planned sale. JetBlue has yet to respond. Spirit is re-examining its balance sheet after the U.S. district judge sided with the antitrust regulator, saying the deal would lead to higher fares. Tier 2 airlines, the whole point where I come from in Europe and in the Middle East, it is about consolidation because those low-cost air carriers had to consolidate in a post-COVID world for efficiency. All hail Michael O'Leary at Ryanair.
And of course, when it comes to JetBlue, it needed capacity. And by buying Spirit Airways, that would be one way to solve that problem, because ordering planes from Boeing would take years and years before it actually comes to fruition. JetBlue, Spirit stock has fallen about 62% this week on this DOJ pushback, this DOJ blocking the merger. But if you look at JetBlue stock, it's up about 3.3%. So I don't know that it's motivated, to necessarily go appeal that ruling.
Look, I think when you look at the debt structure, and we'll move on in just a moment, Citi downgraded Spirit to a sell from neutral because $3.3 billion, that's what the debt level was just a couple of years, to $5.5 billion. That's the noose around their neck. Can you refinance your debt? And if you can, then good luck to you. Let's move along. YouTube, Spotify, they're following Netflix in snubbing Apple's Vision Pro, announcing they will not launch the app for the tech giant's mixed reality headset. This is all, of course, about Vision Pro. It's available, pre-order starting today, giving Apple its first real taste of consumer demand for a device over $3,000.
$3,499.
I knew you were going to do that.
Yeah, I mean, over $3,000 doesn't really tell you how expensive it is.
Amy, that's another $500 on the price. You know, every $500. That's the producer of this show. There's a $500 top up there. This takes me back to when you got your first mobile phone. You went, oh, that's so expensive. Would I spend that on a mobile phone? And then the commoditization of that. But this is about snubbing Apple, isn't it?
This is about snubbing Apple. You know who is taking part? Disney Plus, Max, Peacock, ESPN, and Amazon Prime. So all the streamers that are busy fighting for market share, they've bought in. They're going to launch new apps for the Vision Pro's operating system. What YouTube, Spotify, Netflix all say is that, you can use our service through the Safari app on the device. So you can get to us in a roundabout way. We're just not going to bother with coming up with the technology right now for you to launch into us right away.
And of course, they go on sale today, the pre-orders. So I think the numbers are 300 to 400. Do that again. Slow down. 300 to 400,000 units this year, generating $1.4 billion. I don't want to spend $3,500 on a headset.
No. You wonder if it's going to be like the Apple Watch, where there's a lot of fanfare, because with every Apple launch, there's a lot of fanfare. And then it kind of takes a slow build to get to, some point where there's momentum for enough other people to want to get in on it.
Geopolitics, never far from the show's attention. The Houthi militants in Yemen firing missiles at another US-owned ship in the Red Sea. This is the third such attack in 3 days. And President Biden acknowledging US airstrikes have not halted the attack, saying, quote, they are stopping. Are they stopping the Houthis? No. Are they going to continue? Yes. And then we had this statement slightly walked back by the State Department, which is, that's a tacit admission that what I'm doing is not going to have a major impact. But I think it does show the distance between verbiage from the UK and the US. David Cameron was in surveillance in Davos saying, we warned them, we warned them, we warned them. And finally, we took action, and Biden reaffirms there will be more.
Yeah, well, I mean, the White House, the UK, between a rock and a hard place here. It's very difficult to move forward on this. There's so many different moving parts, and the Houthis are incentivized to continue doing this. We know the White House has now placed the Houthis back on the global terrorism list to blunt that group's ability to raise funds. And of course, it was President Biden who had removed the designation a few years ago to ensure that they would have access to humanitarian aid following years of civil war in Yemen.
Okay, well, let's talk about the U.S. economy, because defense is a core part of that economy. To Lindsay Piegza, she joins us now with the very latest views on the U.S. Lindsay, good to have you with us. I look at this week and I keep getting smacked in the head by retail sales, jobless claims, the lowest in a couple of years. This is a strong consumer. This is a strong U.S. economy. But is there anything in the soft data, is there anything out there that says to you, Manus, I think it's not as robust as you all think at the end of this week?
Well, I think at this point, the U.S. economy is faring quite well. We continue to see, as you mentioned, a very resilient consumer. So we do expect growth to remain positive as we look further out into the new year, but at a slightly reduced pace, certainly from that outsized rise that we saw in the third quarter. As we await the final print of Q4, likely half what we saw in the third quarter, before growth slows further to about a 1.5–2% average annual pace in the new year. So consumers are still spending, businesses are still investing, but it's also clear that there's a loss of momentum. There's a sense of fatigue setting in that, again, will keep growth positive, but also positive at a slower pace throughout the new year.
Right. And the consensus estimate right now for that fourth quarter GDP print that is coming out on the 25th is for 1.9%. That would be a dramatic slowdown from the 4.9% that we got in the third quarter. So, Lindsay, as you wait to hear the earnings comments from the different CEOs, I'm wondering what you're gleaning, certainly from the big banks, in terms of the spending environment, the demand environment.
Well, when we look at the household balance sheet, what's very clear is there's still a lot of borrowing power. There's still a lot of spending and investment power from the side of the consumer. And so I would expect, again, the consumer to continue to support growth going forward into the new year. This willingness to spend dollars, ramp up debt. We've seen the consumer find additional factors to support that loss of earlier fiscal and other pandemic supports. We've seen a turning to 401ks, hardship withdrawals up double digits, this reliance on generational wealth transfers, and of course, consumers turning to credit card debt, with that outstanding balance pushing well over $1.1 trillion at this point. So consumers do have access to other funds, and they're going to continue to spend those funds as long as they're available.
Right. That's the one consistent thing about the U.S. consumer. They will continue to spend, and that's something Manus and I are joking about. How does this affect their perception, American consumers' perception of current conditions and where they see prices? We've got University of Michigan numbers coming out at 10 a.m. And of course, one of the points that everyone looks at is the one-year inflation outlook and the 5 to 10-year inflation outlook. I think it's difficult to figure out what inflation is going to do later on this year, let alone in 1 year's time or 5 to 10 years' time.
Oh, absolutely. Well, the consumer right now is feeling relatively firm. They're feeling relatively solid because they do have access to these additional funds, and they're not necessarily feeling that threat of falling off a cliff. That being said, higher borrowing costs, elevated prices, this is compounding the weight on the average consumer, and consumers are feeling that. Remember, price pressures are slowing, but nominally prices are still rising. So consumers are having to shift and just make decisions about those purchases on a month-to-month basis, and this is weighing on their not only ability to spend, but their willingness to spend, as well as their expectations for future prices as we look out into the future.
And there's a real bifurcation out there. You speak to the Carnival CEO, you speak to the Moët Hennessy CEO, and they're telling you that there is no slowdown in demand for cruises, for champagne, for high-end wine. So I think there is a bifurcation in the consumer, and we need to remember that in terms of the kind of CEOs that we talk to. What I am curious to know is this. We have been told this week very, very clearly by Waller that the cuts will be methodic. They will be cautious. Bostic reaffirms that. I just wonder, we're being told this is not GFC, this is not pandemic, this is not taper tantrum land. So the cadence of these rate cuts, we really do need to recalibrate. Do you think we've recalibrated sufficiently? And what speed and scale do you think we will get 2024, 2025? Nobody's talking about 2025. So put it together for me.
No, I think the market is still very much ahead of itself. The Fed has been very clear that they're willing to have the conversation about rate cuts, but the support for initiating those is not unilateral. It has to come with the prerequisite that inflation continues back down to a sustained 2% level. And the data right now does just not support that. And so the notion that the Fed would be willing to engage in rate cuts in the first quarter very much seems unjustified. In fact, looking at the data with growth accelerating beyond earlier expectations, and as we just talked about, a very solid consumer, I think the expectation for even a second quarter cut may be too early to price in. I think the Fed is going to be sitting on the sidelines until the second half of the year with a very tempered pace of reduction. So the market is anticipating 25 basis points a month. I think it's going to be more about 25 basis points a quarter, keeping us well above neutral, to your point, as we look out to 2025 and beyond.
There's also concern that inflation will start to reaccelerate as well. Given the data that we've been seeing from retail sales, from jobless claims, it's clear that the U.S. economy continues to be very resilient. What part of inflation are markets ignoring or overlooking? Mohamed El-Arian was telling Bloomberg that it's in the service sector. We see, of course, oil prices struggling to move above for WTI $75, but if it does get there and blows through, that could be another source of inflation.
That's right. Goods inflation has come down precipitously, and in some cases, we have seen outright deflation. But it's the service side of the equation that continues to be a problem for the Fed, particularly when we look at the underlying component of wage inflation or wage pressures. And so right now, when we look at the unevenness of the data, when we look at the painfully slow pace of disinflation for the overall key metrics of inflation, again, it's not convincing that we're on a sustainable downward trajectory. The Fed wants to see more evidence, and with a number of risks out there in the marketplace, including geopolitical risks, shipping costs up 130%, which could lead to a spike in goods costs in the mid part of the year, the Fed simply is not willing to begin to unwind all of the work they've done to slow inflation prematurely. So again, the Fed is going to be very patient and likely on the sidelines for significantly longer than the market is anticipating.
It's just unfortunate that the bond traders haven't acquired that sort of patience and sort of deliberation, but maybe they'll be whipped into shape. Lindsay, thank you very much for joining with us. Lindsay Piegza of Stifel with her views on the markets. We're going to talk about Jamie Dimon's pay rise in a wee minute, aren't we?
Yeah, well, I mean, Lindsay mentioned wage increases. Jamie Dimon got a pay raise. You know, a little bit better than inflation.
35. But of course, it was skewed towards delivering on the incentives.
Deferred compensation, I believe, is the word.
Deferred compensation. Yeah. We've all seen that. Anybody want a snapshot of risk? Let's have a look at this. There you go. Look at that. Rock and roll. Equities, Nasdaq took out high yesterday. SPOOs are up 0.5% this morning. We'll risk on for this Friday ahead of the University of Michigan numbers. Coming up, Bloomberg's Lisa Abramovich with the highlights of this week's World Economic Forum from Davos. Good morning. Bloomberg's Lisa Abramovich has been in Davos this week speaking to the business and the political leaders from around the world. Lisa, good to see you. You and the team looked as if you had a mighty week. If I said to you, how would you encapsulate that week? What would that be? What would define the week of Davos 2024?
Manus, thank you so much. And I will say the one word that would encapsulate 2024, the Davos here, is enthusiasm. Just incredible enthusiasm and optimism from a lot of business executives, which honestly is sometimes you could say they're talking their book. But this time it sounded like they felt the economy was rounding a corner. Take a listen.
The banks are going to trade really well. They're going to have really good numbers all year long because now there's reasons to trade.
That's what we're off to do, is to rebuild the Americas and the European supply chain for semiconductors. So, hey, we're all better off, right? We have better jobs, we have better national security, better economic, and we're ready for a turbulent world.
We are very pleased what's happening with automotive. We're now working with virtually every car company. The car is becoming a new computing space, and our job is to provide the digital part.
Travel is doing very well. Entertainment is doing very well. For example, concerts, music festivals, opera, these are doing very well. Wellness products are doing very well.
As calories come under control, we'll see more zero sugars. But at the end of the day, people will still enjoy an original Coke every now and again. That's not going to go away.
So that was some of the takeaways and some of what we heard over there, Manus and Scarlet. Honestly, it's been a long week. I think everyone's very happy to go home after a week of not a lot of sleep and not a lot of personal time. At the same point, at the same focus, though, it was really productive, and it seemed like a lot of things got done. It was not necessarily highfalutin ideas as much as in practice, what can we get done?
Yeah, I mean, it's interesting there that you've got John Kerry talking about the necessity of oil production. I listened into your conversation with Mike Wirth when you were talking about geopolitical risk in commodity markets, and he was surprised about the lack of geopolitical pricing that was in the oil price at this time. And that is just something that goes on and escalates on a daily basis, doesn't it?
Yeah, it is. And oh, I'm sorry, Lisa, go on.
No, I completely agree with you. And frankly, what Mike Wirth's point was it's because we're having 13 million barrels of oil pumped every single day here in the U.S. The question is, how much more can the U.S. pump? How much is there elasticity there in terms of compensating for further disruption? And, you know, these are some of the conversations at a time where it's not clear how we resolve this. That was really clear to me.
Yeah, especially as the U.S. economy seems to hold up. Demand looking better than expected, certainly a lot better than what a lot of people had anticipated at the end of last year. I wanted to ask you, we know that the Chinese premier kind of gave away the China GDP number at Davos, saying that the economy grew 5.2%. There are a lot of negative headlines when it comes to China's economy overall. Moody's downgrading some Chinese bad banks, of course, and then the stock market tumbling before the national team had to come in and buy. To what extent are people even talking about China the way they once did? Or have the global elite and have markets kind of decoupled themselves from what happens in China?
You know, it's a great question, Scarlet, because I wouldn't say they've decoupled. It's this sort of understanding that it's going to be difficult, and the businesses that need to do business in China will keep doing business in China. Qualcomm CEO came on and was talking about how they plan to continue working with them. They're the world's second biggest economy. That's what you're going to do. On the flip side, what was interesting to me was that China sent their biggest delegation here since 2017. Officials met with a whole host of different business leaders to try to basically convince them that it was safe to come back and invest in China. But there was a resignation among most people that the tensions between the U.S. and China are not going away, that you're going to have a problem going forward just in terms of ongoing divisions. Trip.com CEO came on with us. I thought it was very interesting when she talked about how travel is picking back up and that there is the appetite among Chinese to come to the United States, but they can't because of the visa issue. They're not able to get visas. So, you know, a lot of mixed messages, and I understand there's a talking of a book that I think we have to understand. At the same time, it was just interesting to sort of feel the tension of China present here, but understanding things have changed.
Yeah, absolutely, and I'm glad you bring up the missing Chinese tourists, because today's big take on the Bloomberg is about China's severed airlinks draining $130 billion from global tourism. Folks should check that out on the terminal. One thing that you mentioned about rising U.S.-China tensions certainly is that it's been consistent from President Trump's administration through to President Biden's administration. And whatever happens in November, it will continue to be a theme. What are people saying when it comes to the possibility of Trump 2.0?
So we asked a lot of people about this. This was a very hot topic here. And it ranged from a real sense of resignation to frustration to anger to befuddlement to some people just saying, well, you know, he wasn't wrong about certain things. Mark Rutte was talking about that with respect to the NATO spending and European countries really pulling their own weight. The big takeaway, though, I'm glad that you brought that up, Scarlet, this idea of the policies on trade under Trump are not that different as they are under Biden. And so right now, businesses are starting to understand that. The big change with Trump 2.0 is the uncertainty factor, because frankly, that is the sort of hallmark of Donald Trump. It is the unpredictability. And I think that that is really what was hanging over people's heads. Business wants predictability. And that was a big concern for a lot of people here at Davos.
Well, I think the Emmy for dramatic effect goes to Christine Lagarde when she was asked, you know, what was she thinking about in terms of Trump coming back to power? And she just paused. I'll have some coffee.
I would give her the Oscar for that.
You give her an Oscar?
Yeah. Okay. The timing was impeccable.
She's front running it. And this is what she said in response to Francine in regards to a second term of Donald Trump being in the White House. She took a slightly more bullish stance. The best defense is a form of attack, and pushing a strengthening of the European Union by creating a single market. I mean, many people will give you lots of responses. We don't know who's going to be on the ticket. We don't know who's going to be in the White House, Lisa. But one thing for sure is we have two hot wars. We have Hamas, Israel, and we have Ukraine. The Ukrainian foreign minister was with you, and I thought it was quite prescient that he said, it's not that they don't want to give us the money, it's that they've got domestic issues that are a higher priority. So this is a critical issue in the world. Did it rate at Davos this year?
You know, it's a good question whether Ukraine really was as present. It certainly wasn't as much as it was last year. Last year, it was very much front and center. A lot of questions about how it would transpire. This year, it was sort of the drumbeat underneath as another one of the hot wars. I think people have perhaps moved on a little bit more than the Ukrainians would like. But I think the fact that President Volodymyr Zelensky was here, meeting with all of the business leaders, shaking the hands of Jamie Dimon, shaking the hands of all of the different bank executives. I asked the Ukrainian foreign minister, what do you want with these private executives? What support are you hoping to find? You know, there is this feeling, and I will say, and this is just in anecdotal conversations that I had with business executives in private conversations, there's a feeling that some of the public officials are going to business executives for advice for the first time that they've really ever seen. They want to understand what the business landscape is trying to get to be confident. There is a sense of we don't know what to do among a lot of public officials. And to me, that was really a noteworthy kind of revelation at a time of so much uncertainty.
Lisa, thank you very much. Yeah, it's an interesting moment when you get foreign ministers sitting down with Jamie Dimon looking for advice when political leaders are perhaps less present and available. Lisa, thank you very much. Great coverage. You, the team, Anne-Marie and Jonathan, and of course Francine and Haslinda in Davos. This is Bloomberg.
There is some reason for optimism. If you look at inflation around the world, it's on a downward glide path.
If you emphasize the word landing more than soft, I think we've achieved it.
We're going to see volatility, but the trajectories are in place for lower rates, for less inflation, but not on an even keel, if you will.
I believe that the Fed is going to take its time, especially without a recession.
They're going to start lowering at some point. When they're ready, they're going to be prudent, they're going to be thoughtful.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City, for our audience worldwide, good morning. This is Bloomberg Surveillance. As you can see, it's none of those surveillance folks. It is Manus, Cranny, and myself. I'm Scarlet. Everyone is recovering from Davos. They're going to be making their way back, but we have plenty of news to keep you occupied with in the meantime. And Manus, we're just looking at the headlines that crossed on Spirit Airlines. We know the DOJ blocked that merger deal. And yet, Spirit Airlines, there's some headlines here with Spirit assessing options to refinance its 2025 debt maturities. Yes, we knew that was an issue, but more relevant to this JetBlue merger is that Spirit Airlines is still saying that the merger agreement remains in full force and effect. They've also given a pre-announcement of their earnings for the fourth quarter. Fourth quarter operating revenue, $1.32 billion, slightly higher than what the consensus estimate was of $1.3 billion. But Spirit still believes JetBlue combination is the best opportunity out there. You could see Spirit Airlines shares moving higher in pre-market trading, up by 12% right now. For the week so far, it's down about 62%. JetBlue, meantime, this week, up about 3%. So you know that JetBlue shareholders are kind of relieved, it seems, that merger is not going through, or at least the DOJ blocked it.
Well, one man's pain is another man's gain. You know, if Spirit has those material issues in refinancing their debt or their revolving credit, well, that has inherent risk. I'll just leave that thought there. I'm not going to make any predictions on it. I want to give some context around the debt profile within Spirit. So my understanding of it is this. You've got $1.1 billion worth of loyalty program debt coming due in September 2025. I found a fact. And when I find a fact, I'm a bit dangerous. So that is the one line of debt that's coming maturity in September 2025. On the broader context of what is the debt pile for Spirit, it was downgraded by Citi. So it was Citi's note that gave me this data. They downgraded it to sell from a neutral, and they said that the debt sheet has risen from $3.3 billion to $5.5 billion overall in the past 2 years. So that's the weight of debt that needs to be resolved. Spirit are also saying they have modified the revolving credit line in November. Now, we need to get a little bit more detail on that. The question is, will your credit lines help you through? Can you refinance? What do you pay to refinance? And will you make it through that refinancing board? And it's not just Spirit that's going to face this.
No, but Spirit is, of course, facing this first. And the big issue with Spirit is that a lot of analysts had anticipated if this deal did not go through, it would have no choice but to potentially file for Chapter 11 bankruptcy protection. Another headline here, going to what you were saying about the debt due, Spirit had $1.3 billion of liquidity as of the end of December last year, and it's taken several steps to shore up its liquidity during the fourth quarter. Of course, we will continue to keep you posted on this. JetBlue has not made a comment on this, and we will bring it to you when that happens. But if we broaden out our look at what's going on in the financial markets right now, you can see U.S. stocks are set to move higher or open higher, and the NASDAQ continues to lead the way. The NASDAQ closed at a record high yesterday, Manus.
Yep, I mean, so much for the death of Mag 7, so much for breadth. That's just, well, that's 2 weeks ago news, isn't it?
Yeah, well, the markets have a very short-term memory span.
I mean, there's no doubt about it. Tech is on fire.
Tech is on fire. What's not on fire right now is the pound. You can see it lower by 0.2% at 126.80. We did get a retail sales report that was disappointing. It was actually the worst retail sales report in almost 3 years and does increase the risk of recession. But the flip side to this, of course, Manus, is that the dollar is in resurgence mode this year. It's firmer against all G10 and major currencies. So far this year, Bloomberg Dollar Index up about 2%.
Look, short rates went up by 20 basis points this week. 10 years went up by 20 basis points, moving the dollar higher. Wasn't so much risk. Look, it depends on how you write this story.
Sure.
1 week we're writing a story that is risk off and the dollar is bid. The following week it is, oh, we're risk on and, yields back up and the dollar is bid. Either way, we are up 1%. That king dollar narrative remains very much intact. It's strong. It's up 1% on the week. And what would you want as a perfect hedge? I don't know. Volatility is repressed. Do you want the dollar? And yen's not doing its job as the backstop.
Usually when the dollar is higher, we'll see losses in oil. Right now, if you take a look at oil prices, they're holding near a 3-week high. WTI just approaching $75, Brent approaching 80. And of course, we're keeping an eye on all the developments in the Red Sea, the U.S. and the Houthis trading tit-for-tat strikes in that area. Let's bring in now our first guest of the hour, Margaret Patel, Senior Portfolio Manager at Allspring Global Investments. And Margaret, for years, you were kind of known as a bond expert. And of course, certainly you still are. No one ever stops being a bond expert. But most of your assets that you manage now are equities, 75% right now to be exact. I'm curious to get your take as a former bond person and as a current equities person. Are the bond market and equity market looking at the data and what the Fed does next in different ways?
Well, I think the equity market is looking at the strength of earnings. I think that's number one. And really, rates are so low across the board in treasuries, I would say it's almost irrelevant for corporate planning. And so many corporations raise so much money when we have zero interest rates that what the Fed does is really irrelevant to their operating. So we think there is a little bit of a disconnect, yes.
Okay, so equity investors can key off of earnings and whatever optimistic comments the CEOs are making, while bond investors are obsessed with, and rightly so, with what the Fed does next and how it's signaling what it does next. What is your thinking in terms of rate cuts? Are you on the first half bandwagon, the second half bandwagon?
Well, I think the Fed is searching for relevance to show that it has some ability to affect the economy and financial markets, which it really hasn't very much since they started to raise rates. I think really we'll see rate cuts, maybe one or two in the second half. I don't see any reason to expect them to act in the first half. But of course, they'll want to be clear of the election. So if they don't act by summer, then they'll really be in a holding pattern until after the election.
And that is the risk. Margie, good morning. Lovely to meet you. You talk about you're not too stressed about whether there's material rate cuts for the corporate balance sheets. But to what extent does the consumer, does Scarlet, myself, the average normal person, need to see rate cuts to underpin our confidence to spend? We've got jobs, we're being paid, but what material difference will those rate cuts make to the consumer equity side of the trade?
Well, actually, I think very little, because we've had the Fed raise rates at historically faster than they ever did, and yet unemployment is very near the lows. And I think what's more important for the consumers is what are their real wages, and it looks as if wages are more or less keeping pace with the stated inflation level. The top, say, 60% of consumers still have some liquidity. They don't need to borrow. It's really the lower tier that are really hurt, and they're a smaller percent of the whole economy. So consumers look pretty decent to me.
With that in mind, then, you know, certain parts of the market have been wrong-footed. There was this narrative, you know, you want to be less long of Mag 7, you want to go for breadth, you want to be a little bit wary on tech, on rising rates. So some of these consensus phrases that we use all the time are being beaten, they're being beaten back. When you look at the earnings sheet, where am I going to see the strongest earnings growth?
Well, I think the trends that we saw last year are still going to be in place. So that says to me we're going to see a small number of leaders in the marketplace, as we did last year. I think tech is going to continue to have relative strength compared to many other sectors, especially with an economic growth that I think will be more or less modest. So we think tech will do well. Certain industrials that have a lot of capital expenditure attachments, and maybe even healthcare might be near turning around from a bottom and doing a little better in the second half of the year.
So tell me then, when you see big notes come out against big names, like Apple had 3 downgrades, 1 upgrade, and they've got a few issues around some software, etc. When you see significant repricing in any of those really high-end Mag 7 and perhaps even just a slightly broader church than that, do you see that as a re-entry point? Is it a buy the dip mentality that you're going to adopt when you see moments appear in the Mag 7?
Well, I think really we may see those Magnificent 7 go their own way. And again, the reason they've been magnificent is they've had better earnings growth than most of the other sectors. And so if we see a particular company, say Apple, having more decelerated earnings, we may see them not really part of the group because they simply don't have the growth that the other, say, 6 still have. So it's really, I think, going to be fundamentals whether they still maintain their lead.
It's going to be fundamentally driven, which brings us to the tech earnings. We'll, of course, hear from Netflix. And even though Netflix's business model is different from the other Mag 7 companies, certainly it sets the tone for those companies involved in streaming. Are we going to get another year of efficiency kind of theme from these big tech companies, which, of course, cut a lot of costs in 2023 and slimmed things down to boost their margins?
Yes, I still think they're going to be one of the fastest growing sectors. And I think it's because simply these big moves, artificial intelligence, more move to the clouds, that kind of thing, I think is still going to be in place. And that's going to keep those companies having way above average growth rates compared to other sectors. It's not what a lot of people would like to see. So this big broadening out, I think, is going to be rather limited, just as it was last year.
Okay. And we're talking about workforce consolidation. Wayfair, the furniture retailer, has announced a workforce realignment plan. There's some marketing buzzwords. It's going to lay off about 13% of its workforce. The workforce reduction involves about 1,650 employees, Manus, with an annualized cost savings of more than $280 million. And you can see their Wayfair shares moving up in the pre-market right now by 11%. But of course, volume can be limited in these instances in pre-market trading. Margie, I want to come to you on deal making because Lisa Bromwitz and the surveillance team have been in Davos. There's been a lot of talk about lower rates being a good lubricant for M&A this year. And there's a lot of optimism about a lot of that happening. We got headlines this morning from Spirit Airlines saying that the JetBlue merger agreement remains in full force and effect even after the DOJ blocked it. And we were talking about how this creates a conundrum for these second-tier companies, airlines in this case, on how they move forward when they don't have the scale, they don't have the balance sheet to necessarily do that in the face of a government that doesn't want to reduce competition. What does a second-tier company like Spirit Airlines do? How are you thinking through M&A in 2024 when there is so much government pushback, yet you've got the tailwind of lower rates?
Well, I think looking at M&A, I think that what you often see is the best companies are acquired, the smaller companies or specialty companies acquired by larger companies, and typically we don't see the weaker companies being acquired. Those are really the kind of things that you see more M&A in private equity, where they just look at the spread and the cash flow and will have a better bid than larger companies looking for a strategic addition to their corporate earnings.
All right, Margie, really appreciate your joining us today. Margaret Patel of Allspring Global Investments. 75% of the assets that she manages are in equities, and of course, she's still exposed to bonds. And Manus, I look at the Spirit Airlines and the JetBlue Airways merger that is still on, according to Spirit. Interesting development given the opposition, the hard opposition from U.S. regulators and a court decision.
Yeah, and actually they say that there is a line there that the merger still remains in full effect, even though you've had that judgment against it. Now, we've just seen JetBlue open up 1%, so this is going to be a tussle through the morning. Can they refinance? How much will they refinance, and what will the demand be for the debt? And this was something that we talked a lot about in October and November. Remember the wall of maturity, which never really came to pass. You've just heard from Margie there talking about a lot of corporates, and this is a theme that we've touched on. A lot of corporates have already refinanced. A lot of people have refinanced. I mean, I can't get a mortgage yet.
But all the people with their sub 3% mortgages.
Have you got a sub 3% mortgage? Are you going to turn me green with envy now?
Yeah, no, I do. But then also I'm locked into it. I can never do anything.
Can I just tell you, in the UK, I have a mortgage at LIBOR. That's a thing that you all remember. LIBOR. LIBOR plus
There's a
an
blast
eighth.
from the past.
Never in the history of money will you get a mortgage at LIBOR plus an eighth. I can't say which institution sold it to me. They were good.
All right, we've got much more coming up. Maya McGuinness of the Committee for a Responsible Federal Budget is our guest next. This is Surveillance on Bloomberg.
Ukraine does not steal any money from American taxpayers. It's, to say the least, a very little part of the overall defense spendings. Moreover, a vast amount of this money stays in the United States because it's invested in the production of weapons that goes then to Ukraine, and it needs to be explained to American taxpayers that their communities benefit from it. Their new jobs are created.
That was the Ukraine foreign minister, of course, Ukraine officials in Davos making their appeal to U.S. leaders, the global elite, and of course, U.S. taxpayers to send some aid their way. When we take a look at what's going on in the markets right now, it's been a while since the Ukraine war has affected markets. What is affecting markets, certainly for crude oil, and you'd be surprised that it isn't affecting it more, is the tit-for-tat strikes, missile strikes in the Red Sea.
Look, I think when it comes to the oil market, it's about the oversupply. The exports from Russia are on the rise. The demand level is firm, but the supply level, you heard the conversation with John Kerry and Lisa talking about the US producing 13 million barrels a day of oil, but in terms of total production from this country, it's over 21 million barrels. That's gas and oil and all compilated together.
Yeah.
So the quantum, this scale of supply from this country onto the global market is in many ways what's creating that cap. And then, of course, the Russians, part of OPEC Plus, they are pumping like Billy. They're exporting like Billy.
Yes.
Excuse me, there's a qualification.
No, they're exporting, and of course, demand hasn't been as strong as you might have expected from the likes of China, which would tend to absorb a lot of that extra supply, but that's not happening right now with that economy struggling at this point. When it comes to futures, we're looking at gains for U.S. stocks heading into the open. The 10-year yield not doing a whole lot right now, Manus, but it's had a pretty big week. You talk about a 21 basis point move for the 10-year yield. Currently, no change.
Yeah, there you go. I mean, short end of the curve, 20 basis points on it. Long end of the curve, 20 basis points on it. The question now is, do we flick to steepeners? If this U.S. economy is firm, robust, firing on many cylinders, the consumer is strong, the consumer is healthy, part of the consumer, by the way, I'm now part of it. But this is the point.
You're not part of it?
I am.
You are.
I went and spent a few dollars at Christmas time. Mohammed Al-Arian makes this point. Multi-faith in the retail. Al-Arian says the markets have overpriced the speed and the depth of Fed cuts, and he wouldn't be surprised if they only start in the summer. That's in his story this morning on Bloomberg.
Yeah, and of course, markets have been pricing in anywhere from 5 to 6 rate cuts for a while now, whereas the Fed itself sees More like 3. All right, let's bring this all together now and bring in Maya McGinnis. She is president of the Committee for a Responsible Federal Budget. And Maya, we did have Congress actually get to work and do something. They've managed to avoid a shutdown. They've passed some bills that President Biden has to sign, but that would allow us to stay funded until March 1st or March 8th. Does Congress get anything done between now and March 1st and March 8th beyond negotiate the same things that they can't agree on?
Yeah, it's a great question. So the starting point is great, good news. We're not shut down, but no one would make the case that Washington is functioning, not by any account. And so between this continuing resolution and the previous one, basically no real progress was made on actually passing appropriation bills, those things that fund the government that should have been done by the end of the fiscal year at the end of September. And there's no reason to think that there's going to be massive progress over the next 6 weeks. I hope there will be, but there could have been for the past 6 weeks. And so the real concern is if we're limping along from one almost crisis to the next, when does anybody kind of settle in and do the work of appropriating or funding the government, or more broadly, creating the actual budgets that guide the government? Keep in mind, last year, the Senate Budget Committee didn't even bother to suggest a budget. It's as though this is all pretend at this point. And so there's clearly the need for a big overhaul in how we budget.
Yeah, absolutely. I mean, I guess the concern now, and maybe it's not even a concern, it's really just expected reality, is that we're going to kind of lurch from short-term spending bill to short-term spending bill, creating this nonstop cycle. And we can't plan for anything, let alone something like figuring out aid to Ukraine or Israel.
No, that's right. Lurching is the word of exactly what's going on. And meanwhile, the question is politically what's going to happen? How will this affect the speaker? Who's going to vote for what? But no real focus is, there's no space for real focus on strategically, what should we be doing in terms of budgeting? Keep in mind, a budget is a statement of a country's values and priorities. It really is an important governing document. So much is going on in the world. The geopolitical situation has changed massively. Our big programs, Social Security and Medicare, are headed towards insolvency. If ever there were a moment to say, what are our priorities and how do we want to fund them, that would be where we are now. But instead, it is that lurching. And if we end up just funding the government kind of at flat levels or possibly a small cut because there's a default cut that will go in place, none of the decisions about what makes sense to fund and what should we get rid of will have been addressed. And all of this is with the backdrop that this budget that we don't have only focuses on 1/3 of the government. 2/3 of it are on automatic pilot programs that are growing faster than the economy, and they're getting no attention as well. So while we have these huge issues of the supplementals, Ukraine, Israel, we need to really think, what are our priorities? This stuff isn't going to be just for this year. This is going to be ongoing. How are we going to handle it?
So, Maya, for an Irish man transplanted from the Middle East that grew up in the United Kingdom, your politics makes the Brits look like a walk in the park. I gotta hand it to you. I don't get to vote, so a lot of our viewers will be happy to know that. But what goes through my mind is, what gets Washington to wake up and actually realize, you're living on, as the French finance minister, Valéry Giscard d'Estaing, said, the United States has an exorbitant privilege. So what is it that gets Washington to waken up? What do you need? A downgrade? Do you need a buyer's strike on your debt? What is it gets politics to wake it up and go, actually, we got to run a country?
Well, so one of the quotes I most live by is from our co-chair, Leon Panetta, who has always said, listen, this is going to happen. Fiscal change is going to have to happen. It will either come from leadership or crisis. And I have always believed it would be from leadership. And I am starting to really believe it's going to only be from a crisis, that nothing else will cause us to act. And then the question is, what crisis will that be? The downgrades should have been wake-up calls. I will add a new problem into how we are budgeting these days, which is there are now many policy problems that we know we need to address, whether it's Social Security or the border, take your pick. And yet you have politicians from both parties actually making the case, don't solve these issues, even if there's a possible compromise to be had, because we want to keep them alive to fight politically. And I say this as a diehard political independent, but when you are running a country with two parties more intent on killing each other than actually running the country, you have a lot of problems. And I think we're stuck there with these huge levels of polarization.
So, Maya, very quickly here, all this talk about business lobbyists pushing for some kind of bipartisan tax deal this year, that's just a pipe dream at this point?
Actually, I don't think so. I think there's a chance that the tax deal that's on the table will move forward. There's been a lot of good work done on it. When I look at it from the perspective of a fiscal hawk, it's actually intended to be offset, gets a lot of credit for that. The policies are temporary, and temporary policies make no sense. They create cliffs. If you look at the longer term cost, it's still very expensive over time and not fully paid for. But the attempt to pay for it in the short run, I think, is important and credible. But I will say, I don't think we should have big tax cuts on the table until we've passed a budget and until we've figured out how to deal with the overall debt situation. Because even if we pay for it, those pay-fors might be better used to get our debt back on a sustainable trajectory. That said, everybody likes tax cuts, and I think there actually is a chance that this bipartisan tax cut will move forward.
Well, it is an election year after all, so there's that to keep in mind. Maya McGinnis of the Committee for a Responsible Federal Budget, thank you very much. Fancy that. Tax cuts going through because both parties want to win re-election. And forget about the long-term plans, you know, the sequencing of how you figure out how much money you have.
Politicians have the capacity to think long-term, do they?
No. It's in 2-year increments, especially if you're in the House.
Yeah, but I mean, I think that's the global thing. The deficit at the moment, by the way, $510 billion, and 21% of that is to do with interest.
Yeah, paying the interest, and of course, it's only gone up. All right. Coming up next, speaking of interest, we're going to speak with Tony Crescenzi of PIMCO, Bond Guru. This is Surveillance on Bloomberg. This is Bloomberg Surveillance alongside Manus, Cranny. I'm Scarlet Food. Team Surveillance, of course, is in Davos, Switzerland, attending the World Economic Forum. In their place, we are taking a look at futures right now, indicating a higher open for U.S. stocks in about 2 hours' time. You can see S&P futures up 0.4%. NASDAQ 100 at least made a record high yesterday, and right now you can see is leading the way among the futures indexes, up by 2/3%. And the laggard here continues to be the small cap index. The Russell 2000 is higher right now, futures that is, by 0.2%. But what happened to the whole, market breadth is going to come back in 2024?
Yeah, everybody just sort of got off that bus and just went, you know what? I mean, there's a couple of phrases I've learned since I've been on this show. One is, weaponized FOMO. One is JOMO. And what is that?
JOMO?
The joy of missing out. But what we've got now is weaponized FOMO for Mag 7, because as for breadth was this narrative for the first couple of weeks of the year, and everyone, you know what, this bus has left and I'm not on it. So it's like,
Let me get back on the MAGA bus. The Mag 7 bus. MAGA bus is a whole different thing.
MAGA bus is a whole other thing.
Yeah.
A little bit of Mag 7, you can't go wrong, can you? Well,
No.
We'll see how that plays out for the rest of the year.
How are bonds looking?
Hey?
How are bonds looking?
Bonds are looking frisky. You've got Waller and Bostic just saying, back it up, boys and girls. You've all got far, far too presumptuous. Mohammed El-Arian endorses that view. Twos flew higher by 21 basis points this week. We gave a pip back this morning. Tens likewise. There is this building narrative, soft landing, strong consumer, strong USA economy. Why is the yield curve not flipping around from inversion to a steepener? But we can debate that with our PIMCO guest in just a moment. But this was a virulent week for bonds, and the equity markets and tech just said, nah, we're not bothered. You know what? We're just going to go long.
We're just going to go long. By the way, no economic data at 8:30 a.m. this morning. We don't get data until 10 a.m. after the market opens. And very quickly here, just taking a look at oil climbing from a 3-week high. And of course, the escalating tensions in the Middle East continue to keep us on notice. All right, under surveillance this morning, the CEO of JP Morgan, Jamie Dimon, getting a pay raise as the bank posts the highest annual profit in the history of American banking. Now, according to regulatory filings, Manus, Dimon was paid $36 million in 2023. That is up from $34.5 million a year earlier. For anyone keeping count, that's a 4.3% increase. You can compare that to your own salary increase that you might have gotten or might not have gotten.
Have you filled in your eval yet?
I've not done that yet.
We have the Bloomberg eval period. The question is, 4.3% sounds quite reasonable in the inflationary environment, but of course it's about delivery. It's about shareholder equity delivery. They pulled in $49.6 billion last year. But there was something for everybody. Daniel Pinto got $30 million.
Yeah.
Mary Erdoes, she got $27 million. She's the global head of wealth management. So it wasn't just for, the Don Juan of Wall Street. Everybody got a little bit of pie at JP Morgan.
Yeah, by the way, those raises, Dan Pinto and Mary Erdos, raises of at least 5%.
Yeah.
Of course, in coming days, we're going to hear from, we'll get filings of how the other big banks are paying their CEOs, and we'll bring that to you when it comes. The one thing, of course, when it comes to Jamie Dimon and any conversation about him is what's going to happen next. He's been atop the JP Morgan management chain for 18 years now. He has the longest tenure of any big bank CEO. Is he going to step down anytime soon? Whenever you ask him that, he says, oh, ask me in 5 years.
Well, we desperately tried to get him to answer the question, would he run for president of the United States of America? And he sort of like swerved that so elegantly. Look, you look at the comeback of Sergio Amotti back to UBS. There is an enduring sense of, I suppose, support when you see the figurehead at the top of these banks enduring for a long period of time. Brian Moynihan, Sergio Amotti coming back. You have Jamie Dimon there. You know and understand what it is their policies are. One is about a real determination on dividends and return on equity. And Amotti will deliver, we believe, a review on those targets in 10 days' time on his numbers at UBS. Of course, they want to be the Morgan Stanley JPM of the United States of America. Good morning, Sergio.
Good morning, Sergio. All right, let's move from the big banks to the big retailers because Macy's is cutting staff and it's closing stores. The department store chain says about 2,300 employees will be let go, mostly in corporate roles. 5 stores will also be shut down. According to Macy's, the moves will help it become a more streamlined company, corporate speak. We also know that in terms of timing, this comes as the PE firms Arkhouse Capital and Brigade Capital have made a $5.8 billion offer to take it private. And there's going to be a management change over at Macy's too, right? Because the CEO, Jeff Jeanette, is retiring in February and making way for the president, Tony Spring, to succeed him.
Look, this is all about structural change. We've talked about it ad nauseum for the past 5-10 years in the ever-escalating onslaught of Amazon in your life and other delivery mechanisms to you for shopping at the high end, at luxury end. And that's only in its infancy. So this is more about how do we actually transact, how do we buy, and do you want that level of real estate? This goes back also to a whole much broader conversation about commercial real estate as well, not just in retail, but on a U.S. and on a global basis.
Yeah, speaking of commercial real estate, you've gone to the Bloomingdale's right next door to the Bloomberg office, right?
I'm a keen shopper there.
Yeah, that's some prime real estate right there in Midtown East. All right, our final story that we're focusing on right now is Congress averting a partial government shutdown that was set for this weekend. With both chambers, yes, the Senate and the House passing a short-term spending bill yesterday that pushes new deadlines to March 1st and March 8th. So we get a reprieve, but not for very long. President Joe Biden expected to sign the legislation, which, interestingly enough, in the House, nearly half of the Republicans opposed.
They opposed it. Yeah, and the question is Mike Johnson. I think we had a conversation a little bit earlier in terms of, he has put himself on a sticky wicket because he promised no more temporary extensions. Here he is. He's just acquiesced to a temporary extension. And the House Freedom Caucus have got form in having retribution, don't they?
I'm just still stuck on sticky wicket. What is that?
A sticky wicket. It's, well, first of all, for an Irishman talking about cricket terminology is always dangerous. So sticky wicket is where the wicket sits on the top of the stumps. You're going to help me now in a minute, aren't you?
I know everything about it.
Yeah, okay. The sticky wicket, it just wobbles, but it doesn't quite fall.
Ah,
So all the Brits out there, they can send in a correction on that. Thank you very much.
All right. We were talking to Tony Crescenzi, who's been sitting by patiently. He is PIMCO portfolio manager and member of the firm's investment committee. Tony, it's so great to see you. Thank you for making it in on this freezing morning in New York. Does the move by Congress to actually pass a short-term spending bill and avert a shutdown do anything for the bond market?
I think the bond market coming into 2024 had very little expectation that anything would change regarding the trajectory for U.S. debt. In fact, it hasn't changed in quite a long number of years. I would say, though, that in 2025, we may begin to see what I would call a read my lips moment. Read my lips for George Bush, 1988 presidential candidate, in a speech written by Peggy Noonan, who was a famous speechwriter for Ronald Reagan. In what she said was the best line of the convention, George Bush said, "Read my lips, no new taxes." He wound up breaking that pledge 2 years later because the interest payments on the U.S. debt had grown substantially to a record high, 3.2% of U.S. GDP. That's a level that hasn't been breached since. Today it's at about 2.5%. It's doubled in the last few years because of high indebtedness and high interest rates. It's going to breach the George Bush number in a few years' time. Interest payments will be over $1 trillion, more than defense spending. Then the bond market will begin to say, and investors will begin to say, and the public will begin to say, what's happening here? We can't take much more debt. Just like in the UK a year and a half ago when Prime Minister Truss was pressured out, in part because she had a debt proposal that the bond market rejected.
Can you honestly, I mean, everybody sort of smacks me back when I say this, you know, can you imagine some kind of a serious jolt and strike against US Treasuries, as happened under the Truss government?
Well, the way it would likely play out is, as it did under the Truss government, is where the bond market would react to proposals to raise indebtedness further in a very negative way, meaning interest rates would rise, but that rise in interest rates would stop the legislative process in its tracks and prevent the indebtedness from worsening. So I wouldn't worry about it too much, but we would expect some volatility if there are any proposals to raise indebtedness significantly more, because think about it. We are reaching certain endpoints. You could say, I'll call it a Keynesian endpoint.
That's the title of your last book, one of your last books, The Keynesian Endpoint. You said that in the break. Where do we get to in that?
What's a practical limit to the use of debt? We had a lot of spending after the pandemic and inflation that resulted from it. So that's a practical limit. So the bond market, it would be self-stabilizing. In other words, don't worry too much.
All right, so the bond vigilantes will at some point make their presence be known.
They're in control.
They haven't gone to sleep.
Policymakers.
They're just kind of quiet right now.
Because this is an election year, nothing will happen on the legislative process to stop the debt trajectory.
Okay, well, this is an election year. What's going to happen on the Fed front? Because if the Fed moves too close to November, they're going to be accused of trying to influence the election one way or another. So markets are betting that, okay, it's got to happen in the first half. And once it starts, it can't stop.
Well, you've seen some pushback by Fed members recently, including Governor Waller recently, seeming to indicate that the rate cut trajectory that the market thinks is probably a bit sooner and deeper, as Mohamed El-Erian, my former boss, said this morning. The markets may be a bit ahead of themselves. The Fed may achieve price stability before it achieves its inflation objective. The two distinctly different things. And markets will begin to, probably in 2025 and 26, be comfortable with the idea of price stability. What I mean by that is something that Alan Greenspan, the former Fed chair, and Paul Volcker used to define it as a level of price changes that ceases to influence businesses and household decision making. So we may not get to 2.0%. We'll get to 2 point something, but that 2 point something, if it sort of wavers around there, can still be price stability. But the Fed isn't there yet, so it has to be cautious about acting too soon, because the key lesson of history is to keep at it, as Paul Volcker said, and keeping at it is his book from 2018, until the job is done.
I think part of the problem is that we have recency bias. In other words, we're not going to have a cutting cycle that we had in GFC, pandemic, taper tantrum, and others, and we have a community that has lived, perhaps not back past 2000 in this bond market for a long period of time. You said there's 3 Ds. Don't try and time the bond market. Don't catch a falling knife, but do catch today's yields. So this is rich enough for you on 10s. This is rich enough. Will the curve shift? Do you want to level into this? Do you want to scale into this?
Yeah, so timing moves in interest rates in terms of picking the top in yield is difficult. And lately, yields have been rising. You see the 10-year yield moving from around 3 3/4 to about 4.15 recently. So some investors are probably thinking, maybe I'll wait a little longer, it'll go back to 5%. But that timing decision, many investors historically are poor at it. And today's yields, as I said, so maybe you're worried about catching a falling knife, falling bond prices. So watch your scaling, but do catch these yields while you can, because look at the Bloomberg aggregate real quick. 4 3/4% today. The Bloomberg aggregate, by the way, is sort of like the S&P 500 of bonds, a compilation of high-quality bonds. 4 3/4% is still significantly above the last decade when it was 2.5. In the last 20 years, it was 3 1/4. In the last 30 years, it was 4 1/2. So you're getting yields above each of those long averages. Yeah. And so quite attractive relative to history, relative to expected inflation in the 2s. So you're getting a high real interest rate. And finally, expected volatility. That Bloomberg aggregate tends to move 2-3% or so. Yes, it moved a lot in 2022, but the bond market's going to say no to inflation, et cetera, and the Fed will get the job done. So, Manus, the final don't for the years. Don't fight the Fed. Believe in its ability to to foster price stability.
To
That should
execute.
give you confidence in owning bonds today. And so we'd have all that confidence. And again, this is a very good time to be investing in fixed income.
All right, Tony Crescenzi with the 3 do's and don'ts when it comes to bonds. Thank you so much for joining us.
Thanks, Manus. Great to
Really
see you.
appreciate you joining us. All right, we do have some breaking news here out of Ford. It is cutting its F-150 EV Lightning production. The stock is moving lower in pre-market trading, off by 0.8%. It is reducing production of this vehicle. About 1,400 employees will be impacted, and it sees global electric vehicle sales growth in 2024. Surprisingly, or I should say not surprisingly, given the headlines here, less than anticipated.
This is actually a much bigger and broader conversation than the idiosyncrasies of Ford. Ford down 0.8%. This is about global demand for EVs. This is about Tesla has had problems. They've been consistently cutting prices in China. This isn't about whether you want an EV. This is about the whole philosophy of transition, and that is being challenged, as well as I don't know enough about the F-150, except they are big.
Matt Miller knows a lot about
He
it.
knows a lot
Yes,
about
it's a
F150.
short-term pain point for all these automakers, but
he's ordered a
longer term.
Cybertruck.
Really?
Yeah.
Tony
Orders- I should
Crescenzi
have
and
it
his
within-
Cybertruck.
Within 2 months, I'll have it.
Surveillance on the road in the Cybertruck with Tony.
Wow, can't wait. All right, you're going to have to send us some pictures on that. Coming up next, we're going to speak with Mandeep Singh about the new Apple device that is available on pre-order today.
The new internet players, Google, Facebook, they all want programming for people to watch content. So content is more and more valuable. NBA content is hugely valuable, and so they're fighting over that. I think you'll see some consolidation. You'll see these streamers consolidating, back to the bundling, because it's inefficient to have multiple software systems, multiple marketing. So you'll see a rebundling, but the programming will always be valuable because it's the only thing that really aggregates eyeballs.
That was Steve Paliuga. He is, of course, a co-owner of the Boston Celtics, also CEO, chair, and founder of PAGS Group, talking about consolidation in the streaming space. It has yet to happen despite Paramount's best efforts to put itself on the sales block and look for buyers. No one has really emerged just yet. Maybe it's more of a price discovery effort. Nonetheless, we'll continue to watch for any kind of deal making in that space. But what we want to talk about right now is the Apple Vision Pro. And Manus, this is the headset thing that they debuted a few months ago, where it just looks like really expensive ski goggles. And when I say really expensive, we're talking about $3,500.
Yeah, I mean, this is about transporting you into alternative universes, seeing
good
content.
marketing speak.
You see, that's me.
Transporting.
In my 4th reincarnation, I will come back as a marketing guru at Apple. So this is just about transporting you into another world and another time. And it's about maybe how we experience all forms of media going forward. There's Apple. It's up double nickel. It's up a double nickel just before the bell. Today's the first day you're going to be able to order. How many of them will sell? 300,000, 400,000? Let's see.
Yeah, the pre-orders begin today, and of course, the actual device launches on February 2nd. Let's bring in Mandeep Singh, Senior Technology Analyst at Bloomberg Intelligence. And the headline here for the Apple Vision Pro is that YouTube, Spotify, Netflix, they've all declined to launch a new app for the operating system of this device. Why is that? Is this just they want to be convinced that this product is viable?
Yes, as well as, these companies have the engagement right now. If you look at where people consume Netflix, Spotify, and YouTube, it's on PCs and their smartphones. And they have those billions of hours of engagement. Why would they want to cannibalize that with a new device that potentially could work, but what are they going to get out of it? Apple is not paying for content here. So there is no incentive for Netflix, which, by the way, doesn't let you even sign up on a mobile smartphone because Apple takes 30%.
Right.
And we are going through that drama with Epic Systems' case. So clearly, the incentives for all these content players is very low in terms of making this device successful.
The lack of YouTube, Spotify, the lack of Netflix plugins, can it materially hit the demand outlook? Because what are they penciling in for this product?
Well, so with any new Apple device, there will be diehard fans that will come and buy the product. So I wouldn't be surprised if it gets sold out, in terms of pre-orders first week itself. That's going to happen. But the question is this a niche category or a broad variables market like an AirPods or an Apple Watch? And on that front, I do think, headset computing in itself has been a niche category. Look at how much Meta has spent. They have spent $50 billion since 2013, last 10 years, and they have generated $5 billion revenue.
You're talking about Oculus, right?
Yeah, Oculus and what they've done with Reality Labs. They've poured in $50 billion.
Why does it not, I'm not going to say not work, because that's not
Why is it not
true.
taking off?
Why is it not taking off? Is it generational? Is it price point? What is it that's causing us not to want to sort of legally get away from it all?
Yeah, I mean, look, they've tried at the low end. Meta's lowest price device is around $400. So it's not about the price point. In fact, Meta is targeting mass adoption. But I just think it's a niche category.
$400 versus $3,500. I mean, there must be a difference in quality.
So Meta is going for quality here with all the bells and whistles.
Right.
They want to make sure you have a good experience when you put the headset on, all the processing power they need within the headset. I still believe headset computing as a category is a niche category. It's like gaming consoles. Why do you want to use headset computing in everything?
But if anyone can make it something big and make it something desirable, it would be Apple, right? Because it's been able to launch these new product categories in a way that others haven't.
Yeah, I mean, look at the watch. The Apple Ultra watch has, I think it's gotten a lot of traction. For good reason, because they have combined a lot of things that people want to use when they think about fitness. But it's taken 9 generations of Apple Watches to get to that Ultra. So it will be a grind even with headset computing, and it will take multiple versions to get to that form factor. Still, I don't think it's a mass category, and that's the fundamental thing people are trying to figure out. Is it like PCs and mobile phones? Or is it a niche category? And the answer is latter, I think.
Well, when it comes to Apple, does the Vision Pro represent a push again to keep refreshing its hardware line? Because we know that services is something that it's really been focused on. Higher margin and recurring revenue is always preferable to the blips that new product launches create. You look at the stock for Apple this year, it's down 2%, definitely trailing the other Magnificent Seven companies. And it's lost the market cap leadership title to Microsoft. What is it that Apple needs to do when it comes to the Vision Pro to change the narrative on its products and its buzziness?
I mean, look, from a device category perspective, it's great that they're adding another line. Whether it's a niche category or a big category, time will tell. I think they really are trailing when it comes to the AI front. That's where Microsoft has taken the lead, and for good reasons. It's probably 2 to 3 years ahead of everyone else right now in terms of their OpenAI partnership, what they have done in terms of Copilot launches, and that's where Apple needs to catch up because they don't have a generative AI strategy till now.
It's interesting how the momentum for generative AI will be the fundamental differentiator, even within Mag 7. I want to talk about Apple Finance. Apple, we have these headlines, Apple's to open up to its rivals in Europe. This is on the ability to use your phone, to tap and pay. So it's really trying to get past the European Commission. They've offered a 10-year to other providers for the mobile wallet. How big will Apple Pay be as we go forward? We've got all the issues within Apple, but ultimately, it's about transactions and banking and money, isn't it? That's where the alpha can be.
Yeah, I mean, look, vertical integration always works when the experience is seamless. And what Apple Pay is doing, they've made that payment experience seamless. But they are getting a lot of resistance from the ecosystem as well as from the regulators. The whole, take rate that they have, 27% to 30%.
Chunky.
That's what everyone is sort of revolting right now. And there will be a fee compression. And that's where you are going to see... Yeah, I mean,
at some point, it will happen. All right, I'm looking at the Magnificent Seven and how it's done so far this year. As a group, up 1.8%. NVIDIA leading the way, up 15%, far away the best performer here. And chipmakers just got another lift this week when TSMC came out with its projection that it sees growth in 2024. How does this change the narrative on a sector that's, kind of trailed everything else within the tech world?
Well, so I think when it comes to hardware refreshes, everyone is waiting for that, AI PC and AI-based refresh cycle. That hasn't transpired. Right now, everything has been data center driven, and that demand will persist. But I think the bar is so much higher that the room for positive surprises is going to be much lower this year than what we had last year.
Yeah, TSMC, of course, continuing to gain in trading and, of course, giving a lift to the European tech companies. There aren't that many, but there are some chip makers.
Well, there's ST Microelectronics, there's ASML. So there is the one thing that Europe doesn't have the bulk of the technology that you have here in the US. It doesn't have the Apple, the Microsoft, but it has the chips and the gear makers for the chips. Apple is up pre-market. What have we got? Up 0.6%, but Advanced Micro Devices up another 1.6%. Chips all the way.
Chips all the way, and AMD is seen as the second best option, right, Mandeep, after NVIDIA, because whatever NVIDIA can't fulfill because it just doesn't have the capacity, it goes over to AMD.
Yeah, and they gave out a number of $400 billion number in terms of, what these generative AI chips could create in a year, and that sort of demand. So even if they are a distant second, that's good enough to, drive that kind of sentiment. But I still think the bar is much higher to drive those positive surprises, and that's what will, probably restrict how much optimism we can have around the sector this year.
Yeah, AMD, by the way, Manus, up 10% so far this year.
Yeah, okay. I thought I made a mistake there on the open. Yeah, Magnificent 7 levels. Let's see, does that continue to play out? Intel's up 1% before the bell as well. They've had a price rise from Raymond James to $54 from $48. But Apple's had 3 downgrades and only 1 upgrade so far this month.
Yeah, well, maybe things will change with the Vision Pro. If you're interested, go and pre-order it right now. Available on sale.
Would you like one? Okay.
3,500. You're going to spring for me?
For you? Margaret Patel.
Mandeep, he's buying everyone the Vision Pros.
He's one of those diehard Apple fans, and
I'm just trapped in an ecosystem that I cannot escape.
And he's willing to spend to continue to stay in it. Mandeep Singh, Bloomberg Senior Technology Analyst. I don't want to give you a downgrade or anything. We're looking at futures right now, indicating a higher open in about an hour and a half. You also have pound weaker by 0.2%. Disappointing retail sales number there.
As the consumer demand stayed strong, you would start to see kind of a more normal cadence to things.
We think earnings are growing. The street thinks 11%. We think half.
Overall, tech has slowed, but it's still incredibly strong and one of the fastest driving sectors for growth.
What we see right now is a great deal of concern over what's coming. That's going to introduce volatility. I think that's going to continue in 2024.
We're in a great era where there will be some disruptors coming in, and life may change.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, a very good morning. This is Bloomberg Surveillance. Alongside me this morning, it is Scarlet Food. Team Surveillance, we think, wheels up from the
private airport, on private jets?
Airport.
Yeah, on the surveillance private jet?
Authority. Jonathan's there, the Learjet is waiting, Abramovich is on her way, and Anne-Marie Horton on their way down there. They've had a great week in Davos. Great team coverage from everybody. Francine has Linda, the whole team, a global coverage in Davos. But to this morning, what have we got? This is about whether equity markets can survive the momentum that they have on the way up in the face of a spike of 20 basis points at the short end of the curve. This is about readjusting your view on where U.S. rates go. We spiked by 20 basis points on the short end of the curve on 2s and on 10s, and yet technology, the Nasdaq takes out a record high. So much for growth being busted on a blast from a spike in yields.
Well, we talked to different people about this, whether the bond market is seeing something totally different from the stock market. The stock market has earnings to distract itself with. Maybe that's the wrong way to frame it, but it has earnings to key off of, and earnings from TSMC, for instance, revived the chip sector and certainly gave all those big tech names a big boost. And we saw that yesterday in U.S. trading. We saw that in Asia trading, in European trading, and making its way back to U.S. trading once again, with Nasdaq futures leading the way.
Absolutely. And if we look at the flow show from Bank of America, they're telling us technology stock funds took in $4 billion. Now, this is whilst at the same time you saw a net outflow of U.S. equity stocks, but technology is still the destination. So much for the breadth trade, which was trade out of Mag 7, trade into a broader, perhaps Russell 2000, etc. But if you're going to extend, if you're going to have an extension on the rate cuts, in other words, they don't come until, let's say, the summer, maybe even the third quarter, as has been
close to the election. Ooh.
Dun, dun, dun. What does that do to the broader breadth component of value? Does it make it more challenging? I mean, that's an intellectual debate rather than an actual debate at the moment. Tech is flying high. In terms of a quick snapshot for risk, let's just run through it, because we've got dollar resplendent up 1% this week. You've also got yields.
Resplendent. I like that. Yeah.
A magnificent moment for the magnificent dollar.
Up
the
about
presence of
2%
the
this year.
Magnificent Seven. Who ever said that we couldn't do alliteration on this show in the absence of Jonathan, Lisa, and Anne-Marie and Tom? SPOOs are up, double nickel up 0.55%. Euro dollar is flat at the moment. The dollar has strided away as yields repriced up by 20 basis points. As I say to you, you give back a pip this morning. 412 is where they trade. So yields, are they going to level out there? You just had Pimco. We've just had the conversation with him. He likes the idea of layering in here, buying in here. Don't be too greedy. Don't wait for the 5%. And oil is down 1/3 despite flashpoints in the Red Sea.
Well, that's because
again.
we're all pumping plenty of oil. And Russia, in Russia's case, exporting plenty of it. So the world is awash in oil. What did you say about double nickel and S&P futures?
Double nickel. So when you used to make a terrible mistake putting an order in to buy dollar yen, to buy oil or whatever else, double nickel. I want to buy 55 Nikkei futures. That's double nickel.
Okay.
Maybe it's an Irish thing.
I'm going to start incorporating into my daily speech.
Feel free. Resplendent, phlegmatic, and double nickel. You see, you learn things on this show when the others are away.
This is great. First time anchoring with Manus, and I'm learning so much.
It's been a good 2 hours. Let's not kill it for the third.
We would never.
Never, never, never. Let's get to David Lefkovich. He is the head of U.S. equities at UBS Global Wealth Management. Good to see you this morning, David. So we're waxing lyrical about the robustness of the equity market, record high for the NASDAQ, and yet yields are spiking 20 basis points. Can you join the dots for me there? Good morning.
Yeah, happy to do that. Thanks for having me. Yeah, I think as you guys were discussing earlier, I do think it's about earnings. If you look at the earnings picture, we're seeing what we think is a pretty nice reacceleration in earnings growth, which, at this point is really more concentrated in the Magnificent Seven and some of the technology parts of the market. But we think over the course of this year, that's going to broaden out and it's going to start to benefit more parts of the market. But specifically for tech, I mean, if you look at Mag 7, I mean, profits are up like 50% we expect them around 50% in the fourth quarter. So we're seeing some really impressive earnings growth. And I think you have to keep that in mind when considering what's happening with other macro variables like interest rates and things like that. So, I would say it's all about earnings at the moment.
When it comes to the earnings multiple, what kind of propulsion are we going to see? And I'm specifically interested in the likes of Mag 7 because I've had various guests earlier talking about 11% earnings growth and they don't need 3, 4, 5 rate cuts to continue this equity momentum. That was my conversation with Deutsche Bank yesterday, 5,100 on the S&P 500 without any rate cuts. I mean, that's a heck of a call. So earnings growth and your call in absentia maybe of the 6 rate cuts.
Yeah, so I think the important thing is why is the Fed cutting rates? If the Fed is not cutting rates because the economy remains strong, I think the U.S. equity market will be pretty much fine with that. If the Fed is cutting rates because the economy is very weak, well, that's a whole other story. Mm-hmm. So I wouldn't get too bogged down on the precise level of interest rate cuts that are being priced into the futures market and sort of be expected by equity investors. I think it really just does come down to, will the earnings acceleration come through that the market is, mostly expecting at this point? And we think it will. Look, obviously, if Fed rate cuts would help, but I don't. If it's a scenario where growth is still good, and that's why they're not cutting rates, then I don't think that's too much of a downside risk.
Okay, so the U.S. stock market can look past the delay of a rate cut so long as it's for good reasons, that the economy is holding up just fine and we don't really need it, and inflation is still coming down, but not to a point where the Fed actually needs to move. I want to bring in the corporate news that we got at the end of last hour, which is Ford cutting its F-150 EV Lightning production. And of course, Ford is not the only one. We've heard from Hertz selling down some of the Teslas and its fleet. These EV predictions that people had been banking on are not really coming to fruition right now. How does this change the consumer sector? How does this change the auto sector from where you sit?
Yeah, so we're neutral on the consumer discretionary. That's where the auto manufacturers live, and we do think, I think it's pretty clear that there's been some slowdown in EV adoption. There's been some of the low-hanging fruit has already been picked by some of the OEMs, and we're getting into the part of the market where it may take a little bit more effort to sort of penetrate the market. So, but I don't think this is a broader read on the health of the consumer. I mean, we just heard from a lot of the banks. I would say the main message is that consumer spending is very steady in terms of growth. We're also hearing some from some of the retailers in terms of how holiday season went. So I think what's happening in EVs is very specific to EVs. And obviously that has implications for how you allocate to that specific sector. But I don't think this is a broader read on the health of the consumer.
Right. It also has a read-through for the supply chain, of course, for those EVs, all the suppliers there, not just in the U.S., but elsewhere. I want to bring in another headline that we broke for you earlier this morning, which is Spirit Air. It is surging right now after reaffirming its support for the merger with JetBlue, even though the DOJ blocked it. How are you thinking about consolidation in 2024 when clearly there's a lot of enthusiasm for deal making given the expectations of lower interest rates, even as government regulators push back on any kind of combination? Or not any kind, but combinations that might reduce competition?
Yeah, sure. So I think, all capital markets activity, whether it be fundraising, whether it be M&A, I mean, it tends to be pretty pro-cyclical. In other words, when the economy is doing well, when the markets are doing well, that's when you tend to see a pickup in activity. Certainly if you listen to the investment banks, some of which have just reported, I mean, they talk about very robust deal pipelines and sort of a pickup in conversations. So look, I think if we really do stick this soft landing, and investors and corporate management teams start to have confidence that they don't have to constantly be worried about the recession that's coming, and I think you will see some additional deployment of capital and raising of capital. So I think it's just a natural progression. We went through a tough period in 22. Last year was a bit of a rebound, and I think now you're going to see that extend a bit.
Yeah, and it's not just in the U.S. either, where regulators are pushing back. The EU, for instance, Manus, the antitrust regulator there, blocking Amazon's proposed $1.4 billion acquisition of iRobot, the maker of Roombas.
Yes. So, I mean, regulation is going to come and at everybody in every direction. In terms of, David, if we can just get your sense on this. I mean, it's a theme that we've touched on in many different ways, but I'm looking at the UBS note, the CIO monthly letter. Lower interest rates will reduce returns and increase the reinvestment risks for cash and money market investors. Now, if we're going to push later and less rate cuts, is that phantom number, the $6 trillion that's in money market funds, is that going to be slower to release? Is that going to materially impact, let's say, the momentum in these markets, or can we power ahead even without the flow of money out of money market funds?
Yeah, I mean, I think there's a number of different buyers for equities, whether it be what's coming from money market funds, whether it be corporate buybacks, obviously just broader institutional investors. So I think when it comes to the equity market specifically, I think the equity investors have a specific set of expectations. That there's an expectation that we'll see a resilient economy with resilient consumer spending and a pickup in earnings growth. And I think if that comes through, then markets can grind higher. Look, our price target on the S&P is 5,000 for the end of this year. It's not a lot higher than where we currently are. So a lot of this good news, the soft landing narrative, a lot of it is priced into markets at these levels, and there might be better entry points at some point in the coming weeks and months.
Right.
But I think at the end of the day, if the economy delivers, earnings deliver, markets can move a bit higher.
I know you like small caps. Is right now a good entry point for small caps? The Russell 2000 this week, at least, seems to be losing momentum to those big cap stocks.
Yeah, I mean, I think small caps look really interesting here. Like, I mean, it is the cheapest soft landing play that, of any sort of major sub-asset class or sub-segment of the equity market, trading at a steep discount, not only to its own history in terms of valuation multiples, but a very steep discount to large caps. And it should benefit from a couple of different things. First, we're going to see a pickup in earnings growth this year. That should be a clear benefit. That should really clearly benefit small caps. Small cap earnings will probably outgrow large cap this year. Plus a lot of the small cap debt is floating rate. So to the extent that we get rate cuts from the Fed, that's going to have an immediate positive impact on balance sheets. And it tends to be very correlated with ISM manufacturing index. And we think that it's likely that the ISM manufacturing index, which has been below 50 for a long time, starts to improve this year. So I think there's a number of reasons to think that the risk reward looks pretty interesting here for small caps.
Okay, maybe that battle between growth to value it needs just a little bit more nuance in it, perhaps than we're putting on the icing on the cake this morning. David, thank you very much for giving us that additional nuance. David Libovich, the UBS Wealth Management. Our guest this morning, a quick snapshot. We've got Spirit assessing the debt refinancing. They've taken several steps to shore up liquidity. The stock flies high, up 27% this morning, 28%.
Also, its preliminary revenue topped analyst estimates, but the actual earnings doesn't come out till later on.
I must say, 2024 is starting off from a banking perspective quite well.
We feel quite strong in 2024 as all of those investments are going to deliver for us later. But the direction of travel is the same. Clients are still there.
We're cautious because the economy is slowing down.
The regulatory environment's really uncertain in the U.S. The rules around liquidity, the rules around capital, the Basel III endgame.
20% increase our capital doesn't seem to make sense.
Regulators are looking in the wrong place, looking to over-regulate the banks.
It's going to be a bumpy year, but more than anything else, we've got to be resilient. We've got to be prepared to react to news.
The core investment banking activity that we have known with real cost of capital, traditional corporate finance like the mid-90s, I think it's going to come back.
I'm very much concerned about the small and mid-sized banks. They've got several risks happening at this point in time.
There's always concerns, but today the regional banks are stronger.
The banking leaders of the world sounding optimistic in Davos this week, as are markets. As yields rise, equities have risen in tandem. Can that endure is the question I have in my mind. You're looking at the S&P 500 up 0.6%. The leaders in the pack this morning are all in the tech. AMD, Nvidia, both flying higher this morning. So it is about the chips. It's about day two of that solid growth story from TSMC. Apple's flying higher as well. Eurodollar is flat at the moment, and yields give back just a pip or two. We have ramped higher at the 10-year paper by 20 basis points this week. Scarlet.
Let's talk about what's going on in banks, because bank earnings season is pretty much over at this point. The big banks finished reporting, and the regional banks, the bulk of them, have finished reporting as well. They started and they finished. Herman Chan, senior U.S. regional bank analyst for Bloomberg Intelligence, is here with us now. And we take stock of regional banks in a way that we hadn't before because of what happened in March of 2023. Right. What are we learning from the regional banks about how they've fortified their balance sheets following that?
Sure. So after the March and April episode and the banking turmoil, after the failures of a few regional banks, the remaining players have really fortified their capital base, pulled back on lending a bit to be a bit more cautious given the operating environment, and really try to stabilize their deposits. And they've done that by increasing the rate paid on those deposits. So at this point, things have stabilized, and we're past that turmoil back in March and April.
But it's costing them to pay for those deposits.
Correct.
And a lot of those deposits have fled, gone to bigger banks, or gone to higher yielding instruments. What portion of those deposits have come back, or are they still waiting for that?
Yeah, so I would say that some are still coming back, but we have largely stabilized. So we're at a steady state now. Bank balance sheets aren't really growing because there's not a lot of loan demand either. So we're looking at 2024 as a bit of a slog year where there's not a lot of balance sheet growth, and we're expecting potential rate cuts, which could help deliver some loan growth in the back half of the year.
Listening to Ms. Walsh at Guggenheim, she was very clear. She is worried about regional banks. I mean, last year, nobody saw the truck coming down the highway at all. It's a thing called mark-to-market. It's been around for quite a long time.
But you can ignore it for a while until you have to deal with it.
You don't want to worry about that. She is worried, and she's worried on two fronts. They've got several risks happening. Commercial real estate exposure, depends who you talk to on that front, and a refinancing wall in that space. So are they real risks or perceived risks? Because when a lady like this speaks to me, I tend to listen.
They are risk, and the banks are preparing for those risks now. They're adding more to their reserves for the eventuality of loan losses in areas like office, commercial real estate, multifamily apartment lending. So those are risks that are known. They still have to play out over a number of years. So it's more of a slow-moving train wreck at this point where the loans mature this year, next year, and the year after. So you'll see losses, but at this point, it seems like it would be fairly manageable.
So Jamie Dimon and JP Morgan, we shouldn't just put it as the individual, but the institution in of itself, saved the banking system again last year by taking hold of those who were flailing. Will there be a greater consolidation in regional? This is a perennial question.
Yes.
Everybody asks it and they go, oh, here we go.
Right.
Going to be any more consolidation?
Janet Yellen was wondering about that too.
Well, if she's a lot more smart than I am, Ms. Yellen, is there a real case then for significant progressive consolidation? I don't mean crisis consolidation, but real consolidation.
Well, that's the question that a lot of regional bank CEOs are asking themselves now. What's the aftermath of what happened in the banking turmoil last year? Do they need to be bigger? Because if you look at where the deposits fled in March and April, they went to the biggest banks. And the regionals see this as a potential existential issue if another recurrence happens again. So bigger is better. A number of CEOs have talked about the need for scale to compete in these potential existential crises. And banks are looking at potential M&A opportunities. It might not happen in the near term, but over the long run, we're going to see consolidation.
Well, that mark-to-market comes back again because everyone wants lower rates, because if in a takeout, you've got to mark everything to market. So let's wait for rates to come down, and then we can get things going on the consolidation front.
That's absolutely correct.
Right? Okay, I've got to ask you about, given we're talking about crisis, the OCC chief, Michael Hsu, told Bloomberg that regulators may force banks to start tapping the Fed's discount window at least once a year.
Okay.
He sees it as kind of a fire drill, so that banks are better prepared to respond to any kind of sudden flight of deposits. What would the government need to do to make borrowing from the discount window more attractive, aside from ordering everyone to just do it?
Right. I think that's really the case. He mentioned it being more of a fire drill every year, so it makes perfectly sense to be able to be prepared for a potential crisis. And I think the measures that he's taking make sense to me. At this point, the banks are a bit wary just because of optics issues and signaling issues. But if we get everybody on board, and it seems like regulators are a bit resistant for banks to tap the FHLB, the Federal Home Loan Borrowings program as well. So maybe it's a way to ease out of that into the discount window over time.
Is there a contrast to be made between the discount window and the Fed's Bank Term Funding Program, where banks do continue to borrow record amounts because it's proven to be a reliable and profitable arbitrage trade where you borrow cash and then you park the proceeds at your account with the Fed where they earn a higher level of interest?
Right. So the BTFP seems to be getting some uptake over the past few weeks because of that arbitrage opportunity. That is unfortunately going away in March. So it'll be a bit short-lived.
It's like a last hurrah.
Exactly.
We all like a last hurrah. Thinking of which, the mortgage market. Mortgage rates are coming down incrementally from those zeniths. For the regional banks, look, when these rate cuts come, everybody's telling us there's either going to be 3 or 6, a bid and an offer. Okay, one is the Fed, one is the market. But that is going to have a material impact on mortgage lending. How exposed and how much of a floor will that put that real estate lending in the commercial banks? What will it mean for them if rates come down on the residential mortgage market?
Yeah, so residential mortgage lending has been pretty tepid over the past few quarters. When we get rate cuts eventually, you'll see more activity, and that'll help both on the fee income side and the loan growth side. So it would be very much welcome on the residential side of things.
I'm just hoping that my FICO score goes up and that somebody out there wants to give me a mortgage.
You're waiting for mortgage rates to come down.
Yeah. And I'll get a first buyer's mortgage as well. A bit of advice.
Do you spend your weekends looking at property?
Not anymore. My brother has told me I've got to calm down, slow down, and reevaluate my life, which I will do. We'll know more about the property market and rates market by the end of this year. Herman Chan, Bloomberg Intelligence, setting the table. You don't really want to know about my FICO score and my availability to mortgage.
You've got time to build it up.
Yeah, I'm hoping. with one of the big banks.
Open lots of credit cards.
No.
But that helps your credit score initially, as long as you pay for it.
That's where I floundered in the late 90s. We are not doing that again. Okay,
yeah,
we're not
learning the hard way.
We're not going through that again. Let's have a look at the last hurrah. How's my pension fund doing? The S&P 500 rallies a little bit this morning, up 0.5%. There we go. Am I fully invested? That's the question I asked the broker who I know is watching this show at the moment.
Is that double nickels?
That is not double nickel. Double nickel is 55.
Oh, so you can't round it up to 56?
No, you cannot round it up.
That's too bad. Okay.
One and done. At 4.14, we give back a pip on not even a pip.
Barely.
We can't really say anything more about bonds, can we?
It's unchanged right now. Not for the week, but for today.
Okay, surprise of the week has really been the sort of flat response. We'll not use the word phlegmatic again. Flat response on the oil market to heightening tensions in the Red Sea. Next up, Greg Dacko at EY. Good morning. This is Bloomberg Surveillance. Alongside me this morning, it is Scarlet Fu. I'm Manus Cranny. Your regular surveillance team we have it on good authority, standing by to get on their chosen mode of transport back to the United States.
Private jet.
Lear. There we go. Well, nothing else would do. S&P 500 up 0.5%. The stock market is continuing to take its lead from the TSMC, the chips narrative from yesterday. Solid growth. NASDAQ made a record yesterday. And again, the possibility of a rate cut in March goes down to just more than a coin cost, 50-50. We've had $165 billion of a chip rally so far this year. And it is about earnings growth rather than rate cuts that propels this market. Roll it over and have a look at the rest of the market. You'll see bond markets ticking.
They're not concerned with earnings, by the way, the bond market.
They are completely divorced from what's going on in it. I mean, Waller and Bostic re-stoked that fire and re-grasped the narrative to cause the bond market to recalibrate its view on when it would get a cut, how much it would get a cut. And the problem is that you have a group of bond market participants who have recency bias, which is GFC, which is pandemic, which is taper tantrum. This is not where we are in 2024. Message from MVC to the market.
Yeah, well, it'll take a while to get that message through. Everyone's still looking for somewhere in the neighborhood of 5 to 6 rate cuts, according to market pricing.
Indeed. Now, we've had some breaking news, as you and I were on air, in Ford. Ford has announced that they're cutting the production of their F-50 Lightning EV. Now, they say the move will, quote, achieve the optimal balance of production, sales, growth, and profitability. The company instead increasing the production of the Bronco and the Ranger models. Both run on, guess what? Internal combustion engines.
And cheaper as a result.
Look, the bottom line is, what does this say about demand for EV? Is the infrastructure not there, or is it that we don't and we're not prepared to buy EV because we've got range anxiety, or is it because we're a bit more drawn to other propositions? The gas guzzler still lives to fight a long day.
It's a combination of all three, I think, but range anxiety certainly exists. Perhaps the people who wanted to get EVs have gotten their EVs, and for the rest of the population, if you don't have a garage and you can't charge it at home, then what are you going to do? You have to line up, and by the way, when you charge an EV, it takes like 15, 20 minutes to do so, whereas when you go to the gas station, 5 minutes and you're out of there. Time is money, right? So people don't necessarily want to sit around and wait for that. And also, maybe the projections for EV sales just got ahead of themselves. There's still going to be growth, according to Ford, in global EV sales this year, just not as robust as many people had anticipated.
Now, of course, there is an impact on this. You're going to have a few dozen workers will be impacted at the components plants. So this is about adjusting the cadence of what they're doing. In terms of other news flow, Jamie Dimon. He's getting a pay rise. Well done, sir. The bank posts the highest profit on record of American banking. Remember that. According to the filings, Mr. Dimon was paid $36 million in 2023, up from $1.5 million increase from the prior year. And the bank making almost $50 billion last year, with the shares rising 25%. So that, look, you can understand the validation. By the way, that is the highest profit in American banking history. So you can sort of understand this is an incentive-led business. If you deliver the return on equity, you deliver the return for the shareholders.
And he's delivered for JP Morgan for a long time. He's been at the helm of JP Morgan for 18 years. Every every earnings season, we look ahead to what kind of compensation numbers these CEOs get. And Jamie Dimon scoring a 4.3% annual increase. And of course, a chunk of that is going to be in bonuses. What is it called?
Well, 34.5 million of it
pay.
is in performance-based incentive pay. By the way, there was a little bit of something for everybody at JP Morgan. I hope it trickles down to the normal levels. Daniel Pinto getting $30 million. You've got other pay rises for Mary Eddowes, $27 million. So, there is munificence aplenty. But then, of course, that's the pay. We know that pay and wages are something that the Fed are focused on. But with Congress, they have avoided a partial shutdown. They're passing a short-term spending bill, pushing new deadlines to early March. President Biden is expected to sign that legislation, Scarlet, today, despite nearly half of the House Republicans opposing it.
Yeah, I'm fascinated by this because the only way this got through the House with Mike Johnson as the Speaker of the House was with overwhelming support from the Democrats. The House Freedom Caucus was not happy about this. They wanted certain things. They wanted changes to the border policy, which they did not get here. And the big question is, how long does Mike Johnson have in his speaker role? How long will he be able to hold on to his gavel before there's some kind of rebellion from his own conference? And it's not clear. Will it be, past March 1st and March 8th when the new deadline is, where they have to now come up with a new agreement? I don't know.
No, but, that speaker seat is tenuous at best. Greg Dacko is the chief economist at EY. Good morning.
Good morning.
Tell us this now. We've had this quite bullish narrative from Davos. We were just chatting about this in the break. How do you look? I mean, the American economy is strong. The consumer, by all accounts, is robust, even though they're dipping into the last of their savings and spending like Billy on their credit cards. I don't call that strong. What do you make of it?
Well, I think it's a nuanced outlook when you look at the U.S. economy. We still have positive momentum, and I think one of the key pillars to economic activity remains the labor market. We have a labor market that's still delivering a decent number of jobs. We still are seeing job growth around 150,000 on a 3-month average, and we have an unemployment rate that's still well below 4%. So that's what's driving income, and in turn, that income is supporting spending. I think we have to be a little bit careful with the cracks in the foundation of consumer finances. Yes, people are using more credit, but if you look at credit relative to spending, it's not historically that high. It's actually below where it was before the pandemic. So yes, there is a little bit more use of credit, and we have to monitor that carefully because debt servicing costs are on the rise, but it's not excessively worrisome. There are some pockets, credit cards, auto loans, but broadly speaking, consumer loans and mortgage rates, which are locked in at low rates, are not excessively worrisome.
Okay, so nothing like what, the groundwork for the great financial crisis back in 2007, 2008. In terms of data that Manus was talking about that came in better than expected, jobless claims, retail sales, how does that set us up for the fourth quarter GDP print that we're going to get next week? Because that is going to show a measurable slowdown.
Yeah, I think we are going to see a slowdown from the 5% pace that we saw in the third quarter. But we know that the 5% pace was supported by a lot of strong summer spending activity.
Taylor Swift.
Beyonce, and other movies.
I did not. Couldn't get a ticket.
Fans. I wasn't either. But we are seeing that consumers are exercising a little bit more scrutiny when it comes to their purchases. Retail sales were very strong at the end of the year. We saw strong momentum in terms of December sales. We saw a lot of activity. If you walked around in malls, you saw a lot of people buying online, but also buying in stores. What is important to note is that there is a bit of a delta between how much people are spending on a nominal basis and how many goods and services they're purchasing on a real basis, which is a little bit flatter.
Manus started us off by talking about how the Magnificent Seven is back again. Everyone is all in on AI right now. Yeah. Certainly you see it in the share prices like NVIDIA and AMD. When does that start to show up in the data that you track, whether it's GDP, whether it's any other measure?
I think that's a great question because we are at an inflection point when it comes to the economy in terms of this cost and supply issue. We are in a globally supply fragile world where supply constraints remain very much a risk. Productivity growth via process improvements, but also technology, is one avenue through which you can lift, of course, productivity growth and output, but also ease inflationary pressures. Now, it's not going to happen overnight. It's going to take a lot of time for companies to develop the technology, to integrate it into their daily processes, but that will lift economic output. We're doing a series on AI, and we're seeing some potentially very strong boosts, talking $1 to $2 trillion for the U.S. economy over the next decade from Gen AI.
Do you think we're underestimating the speed of adoption of AI? I mean, we underestimated. I remember, do you remember when you had a mobile phone, you said you'll never watch a movie on a mobile phone? Well, I did.
And all of a sudden, 2 hours later.
You'll never watch a movie on a mobile phone. Suddenly we're communicating, we're using Zoom. You've got every app to communicate in crisis on the phone. I just wonder, I look back at Alan Greenspan, you remember the speech that he made about the internet, the bubble, the new paradigm in terms of economics, etc., and he was bang on the money. Has AI an even bigger propensity to be an even more significant contribution to growth than we currently understand relative to the birth of the internet?
Yeah, I think in general, if you look at technological innovations over the past 100, 200 years, the speed of adoption has increased. You're looking at 50 years back in the 1800s to 10 years during the technology age of the internet and computer age to now maybe 3 years. That might be the next environment in which we see those positive benefits. I think the other important thing to note is that you may remember that back in the 1990s, Bob Solow famously quoted that essentially productivity gains from the computer were everywhere except in the stats. And that's perhaps what we might see in today's environment with a lot of positive gains in terms of company activity, but not necessarily visible in terms of the actual economic statistics.
Yeah. You talk about adoption. How are you using AI right now in your day-to-day work? Because you do say that it's helping you do some of the mundane stuff and putting you in a position to, jump in at a later point than where you would have started.
Yeah, I mean, what Gen AI allows you to do is essentially have an assistant that allows you to speed up some of the processes.
Right.
Whether it's writing or data analysis, you can use Gen AI in a way that facilitates your work. Now, you still need to think about, the analysis that you're writing in terms of an economist and how things will evolve in terms of forecasting, but Gen AI really has this ability to simplify and speed up some of the early phases of the processes, and things that perhaps took a lot of time before can be done much faster with Gen AI.
Manus, do you use ChatGPT or any of the AI stuff?
I really genuinely resist it because...
You're old school.
Not so much that I'm old school, but as in I do believe that when you're trying to prepare and create for a conversation with somebody, I just believe you just try and do the research and formulate some kind of thought processes yourself. But maybe I'm wrong. Maybe I'm foolish. Maybe I should just sort of tap it in. Questions for EY Economy, USA. Wouldn't that be, well, I don't know, correct me.
Well, it's quite dry if you do it that way, but if you integrate Gen AI into the daily processes, which is what EY is doing right now, investing a lot in Gen AI and trying to facilitate processes of data control, data analysis, data forecasting, as well as processes in terms of management and leadership. So it's really all about knowing how to use it, and that is one element that we tend to underestimate. Oftentimes, when new technologies come on board, you think about the basic uses first, ChatGPT as a chatbot, but then you have to think about the possibilities that go beyond that and how Gen AI can help functions across the board, not just in specific, what am I going to eat today? How can I create a recipe for tonight?
4 questions for you the next time you come in. Do you use it?
No, I haven't done it yet, although I know others who've used it, and maybe they'll use it to just kind of create a template for how they're going to fill out everything else later on.
Okay, I mean, look, it's
giving you a starting point.
Look, I'm a complete believer in, I've moved away from paper. I used to have paper for every single guest just because I've been caught so short with technology so many times, stuck on a side street or in the middle of a desert. But can we just flip it around? I mean, these are all the progressive, constructive, productive, value-add, economic adds. There is going to be a flip side to AI, which is going to be the less need for humans, and if so, what is the quantum on that? Have we begun to think about how it will impact employment, quid pro quo, unemployment?
Yeah, well, I think it's not just replacement, it's augmentation that we have to think of. When we look at the economic impact of Gen AI, we're looking at the capital investment necessary, the infrastructure, cybersecurity, adoption by companies, development of software. Then you look at productivity gains. If you combine all of those can have a significantly positive effect on GDP growth. We're talking in our baseline 3.5% additional GDP over the course of the next decade in a baseline case. In an optimistic case, about 7%. That's $2 trillion of additional economic output. Globally, you're talking about $2 to $3.5 trillion of additional output. That is going to also create new job opportunities, different job opportunities. Yep. And when it comes to the great job reshuffling, it's not the case that it'll replace all jobs, it'll augment them.
Certainly different ones than we currently think in our mind's eye. And this is about trying to cast forward with your imagination. We need one of those, not the Oculus glasses, we need a new pair of the Apple.
The Vision Pro?
$3,500, send them in, we'll have one. Greg, thank you so much for being with us.
Manus is buying for everyone, by the way.
I'm there. Where's your Amex?
I have that.
Okay, we're going to leave you with a thought on markets. Slipping back slightly, but we're still up 48.33. Stocks are rising. Good morning.
It's interesting to me about the diversity of opinion about rates and stuff. Where we stand on this is that we think earnings are growing. The street thinks 11%. We think half. The street thinks that rates are going to be cut 6 times starting in March. I'm not there. Okay, I can tell you why on that. We think 2 to 3 times.
Ronald Khrushchevsky, the Stifel financial chairman and CEO. Heresy. Not believing that the Fed will cut 6 times. It is a building consensus. Mohammed El-Arian's column this morning. The voice that you've just heard there, and a cacophony of voices from Davos. Readjust your monitors. Quick snapshot of the equity markets. They still believe that earnings are going to blow high and hard. S&P 500 up 0.5%. Euro-dollar flat. 10-year yields blew up by 20 basis points this week on the back of Waller's comments about methodic and cautious rate cuts, and Bostic reaffirming that it could actually be as late as the third quarter. And that's really what it is about, recalibrating your view on this rate cycle, isn't it, Scarlet?
It is, but we do get more Fed speak today, so maybe that will blow those guys out of the water. Goolsby, Daly, Barr, and Daly once again. Daly doing a Daly double for us.
It's the closing act by Mary Daly, by the way, because she will be the last Fed speaker before we go into the quiet period, I think. So let's wait and see what happens there. We've had earnings aplenty. Gina Martin-Adams is the chief equity strategist for Bloomberg Intelligence. She joins Scarlett and myself now. So we have one consistent theme. I've got no sort of like trashy tagline, but I've got one consistent theme from the past 3 hours. Earnings are strong. They will remain robust. They'll be double digit. And that's what will carry us to the higher ground. Gina Martin-Adams, good morning. How strong will the earnings be?
Yeah, I think it just depends on which sector you're looking at. Financials clearly started off the earnings season in the U.S. relatively weak, mostly due to charges related to the FDIC sort of special situation reflecting what happened with Signature Bank and SVB last year. But when we move into tech earnings, which really starts next week, the anticipation is for much stronger, robust earnings growth to emerge. That then rolls into more industrials and materials earnings, which should be relatively weak, followed by consumer earnings. So I think you're going to have this rolling earnings season where we started off weak, we might get strong, we weaken again. It really is a sector by sector story. When you look at the S&P 500, this is kind of a blah earnings season. For lack of a better term, we're looking at about 1% earnings growth. So nothing to write home about for the large index, but certainly a lot of sector and industry stories to follow with the fourth quarter season.
And if you hop on your Bloomberg terminal and pull up your bio, recovery could broaden beyond the Magnificent Seven. My dexterity with typing names into the Bloomberg blows my mind. Here we are. Now, you set the stage, which is you take me back to the beginning of last year. I was in Dubai. It was the halcyon days. It was balmy. It was warm. It wasn't like it is now, freezing and in boots. But here's the thing. Mag 7 growth on the earnings was 31%. The rest of the world was febrile. Yeah. Talk me through how that will play out in your mind, Mag 7 versus the rest of the market right now. And is that what's infusing a bid for Mag 7?
Well, this is, I think, very clearly the earnings landscape was one of the biggest reasons for the Mag 7 to outperform the S&P 500 in 2023. As you correctly note, the rest of the index, when you exclude the Magnificent Seven, had an earnings decline of 6% last year, so clearly was in a recession, whereas the Magnificent Seven posted greater than 30% growth. As we move through the course of 2024, this should be very, very interesting because the consensus is anticipating that by the time we get into the second half of this year, we'll have 13 to 14% growth for the Magnificent Seven, we will also have somewhere between 13 and 14% earnings growth for the rest of the S&P 500. So I think this is one of the big keys to 2024. Will we see that modest rotation with the Magnificent Seven earnings growth rate slowing down a little bit, still maintaining a double-digit pace, but much of the rest of the S&P 500 starting to catch up? You had notable sectors that producing very strong earnings declines last year, like healthcare as well as energy, that should start to contribute to earnings growth this year. And this is a big story for the index at large.
Right. Well, I mean, you have easier comps in the second half, too, given the declines that you were talking about. We know that the Magnificent Seven, notably Meta, for instance, made a lot of cost cuts, the year of efficiency, all of that. How much is the Mag 7 and tech overall getting a boost from cost cuts in their bottom line versus revenue growth?
I think it's a good bit of it. When you look at the revenue lines, though, the Magnificent Seven is growing at triple the pace of the rest of the S&P 500, so it's not just about cost cutting. It certainly was very early in 2023. This is what sparked the recovery, was cost cutting by Facebook or Meta, as well as Google. Across the board, the tech companies generally were the biggest had the biggest layoffs among sectors and industries in early 2023. We've seen the cost cutting, however, give way to revenue growth. And I think this is an important sort of consideration. When you look at something like TSMC's announcement this week, this is about revenue growth now and not just about cost cutting, where revenues are growing at a very significant fast pace relative to the rest of the index. And that's what's really powering the gains for the space.
So you mentioned TSMC, and obviously TSMC makes chips for the likes of NVIDIA, Apple, so it's really B2B. The customers are enterprise customers, and that gives us an important read into corporate spending. Technology exposed is, of course, exposed to both corporate spending and consumer spending, and here I'm thinking about companies like Apple or Netflix. Do we presume that corporate spending is going to hold up better than consumer spending?
I think we're at that stage of the cycle, Scarlet. What we saw last year and the year before, frankly, were pretty significant spending cuts by corporates to catch up with what was happening in the earnings stream. Remember, all the way back in 2022, we started an earnings recession for corporates. So corporates have adjusted. They went through an earnings recession. They're now starting to see cash flow growth again. And that is going to be reflected in capital spending as well as investment trends where you see those pick up. On the contrary, the consumer may not weaken materially, but there's very little to suggest the consumer may accelerate spending in the near term. Everyone, of course, has been on guard for this consumer recession to emerge. Will we start to see the unemployment rate hook higher? As a result, that may deplete income prospects for the consumer space, which may result in relatively flat to slower spending in the consumer leg of tech.
I'm drawn to the narrative around healthcare. Lots of people since the start of the year have been saying, get involved in healthcare, but you need to disaggregate healthcare, don't you? You've got healthcare, which has got high-end AI technology imbued in it, because you talk about the margins in general healthcare, and the general healthcare margins, you would say, are the lowest in nearly a decade, a margin of just around 7%. But they're not all created equal, are they? So how do I begin to take healthcare apart?
Yeah, I think you want to look at large versus small to start with. Within the large cap S&P 500, healthcare is really not about technology almost at all. It really is about large cap pharmaceutical companies dominating the market cap of healthcare. You do have some life sciences companies. Biotech is a relatively large share, but it really is about pharma. What's happening with pharma tends to drive healthcare performance unless you get a rip-roaring gain in the rest of the segments. Within small caps, it's a little bit different. Small caps tend to be higher beta. They tend to have more leverage. So I think it's a very different story whether you're looking at large versus small. In the S&P 500, it's about pharmaceuticals. And will these pharmaceuticals companies get past the charges that they've had to make, start to see more activity emerge over the course of the year ahead? I mean, you've got hospitals and providers in there as well. I don't think that's a tech play either. So you really do need to pick your spots relatively carefully. And what we're seeing in healthcare, really, especially in the large cap index, is very difficult earnings conditions. This was one of the worst earners throughout 2023. The anticipation is those easy comps may produce some earnings growth in the year ahead, but it is just about easy comps. There doesn't appear to be a lot of optimism in a longer term revenue recovery emerging just yet.
Okay, we'll keep an eye on those sectors. Gina Martin Adams, Bloomberg Intelligence, setting the stage on the earnings season so far. Next week's going to be, was next week the busiest week of it all? It's going to be
so far it's going to be the busiest, but I think it's going to be the second busiest overall. Netflix begins reporting, so it kicks things off for big tech, as Gina was mentioning.
Okay, make sure you don't share your password. We want to talk about Wayfair. Wayfair is spiking higher.
Yep.
They're in 19. I mean, this is a very strange phrase. This is called workforce realignment. But we're looking at, what, 13% of the workforce?
They're cutting jobs. 13% of their staff globally, 1,650 workers, and 19% of its corporate team as well. So the first quarter cost will be anywhere from $70 to $80 million.
Look, I'm only beginning to understand some of the brand names here in this country and where you go and where you go to shop. So unfortunately, Wayfair isn't on my sideline.
If you were here during the pandemic, you would know Wayfair because everyone ordered furniture off of Wayfair.
But here's the canary. I'm not saying this one stock is the canary in the U.S. corporate coal mine. But when you begin to see fundamental changes in companies like that, beds, living rooms, etc., that's where the tough parts are. And this is about the truth for the consumer.
Right, and consumer spending might start slowing in 2024.
Indeed. Coming up next, The Open with Lisa Shallett of Morgan Stanley, Zachary Griffiths, Credit Sites, along with a whole host of guests on Bloomberg.